with Bankia, potentially creating a third big national bank to challenge Santander and BBVA. Matt?
All right, well, we are looking at futures that are falling lower 10 seconds ahead of the open. So the Euro Stoxx 50 futures, for example, are now down. We're looking at a drop of 0.2% on FTSE futures. Let's see what happens when the cash trade starts. It starts now. Pull up the global macro movers screen, and you can see straight out of the gate the FTSE, which has had one of the weakest futures trades this morning, drops 0.3%. We did see some equity indexes trading higher with futures still, including the IBEX 35. And that's the Madrid index that's open there, a little bit up right now, 0.1%. The CAC 40 opens up down 0.6% as the FTSE continues to move lower. So with the exception of the Spanish index, it looks like we're going to see a lot of red arrows in the left-hand column of this global macro movers screen. As these equity indexes open up, they will continue the slide that we saw yesterday in European stocks and then really accelerated in the U.S. Let's get over to Danny Berger to talk about that. You know, Danny, we saw this whole year, when the U.S. has been up, it's been up more than Europe because they're heavy on tech stocks. Now when the U.S. is down, it's down a lot harder as well, right?
Absolutely, and I think that's one of the reasons why the sell-off yesterday in the U.S. felt so severe, because really the S&P 500 has become so concentrated in these tech names. The momentum behind it is all about tech. I mean, if you look at the gains we've seen over the past month or so, the green bar is the NASDAQ. It really leads the way up more so than the equal weighted, which is in blue, and the S&P 500, which is in white. So you have this really strong trend that people are globbing onto, and not just institutional traders, but you also have the Robinhood retail sort of community as well. So when we get the sell-off, it's a sell-off in high beta names, which also happens to be tech. Now, if you look at the next chart, one of the more interesting features of this as well is where most of the pain was concentrated. It's what Barclays calls the new concept type stock. So that's your Tesla, that's your Zoom. Zoom is the bottom line here, falling nearly 10% yesterday. A lot of these names are also ones that have a lot of option interests about them, a lot of call options. So Apple is included in this as well. Apple is in the blue, Tesla in the white here, falling 8% and 9% respectively. So where do we go from here? Analysts look at this really concentrated nature. Barclays, for their part, says U.S. stocks continue to climb the wall of worry because it was really this frothy market driven by retail traders. That's what we saw knocked down. It wasn't anything else. We didn't see havens move. There wasn't a flight to them. We did see some value kind of names like Carnival do better, but still, it really seemed to be concentrated in, again, the Apple, the Teslas of the world. Matt, Anna?
Danny, thanks very much. Danny Berger with a look at the tech phenomenon and what we saw in that sell-off yesterday on Wall Street. As she says, futures suggest we'll see more of it. Just a quick word on what's going on here in Europe. Matt rightly was pointing out the outperformance of the IBEX, and a lot of that to do with the Spanish banking sector and M&A there. So CaixaBank and BBVA both trade higher, outperforming the market. CaixaBank in particular up by more than 7% in the early part of the trading session, and so we do see the IBEX outperform. That is not to do with tech, that's to do with banking M&A, a new theme for us to deal with. We'll come to that in a moment with Bob Parker, but first let's get to the technology themes, and Bob Parker joins us, Investment Committee member at Quilvest Wealth Management. Bob, really good to have your breadth and insights to guide us through M&A in Spanish banks and the tech sell-off, of course, the big global theme. On the tech sell-off, do you think this tech sell-off means something for broader equities or for other investors, or is it just very much concentrated around big tech names that, let's face it, have come so far so fast?
Well, if you look back over the last few weeks, I think we had a number of warning signs on what potentially could happen in markets. And, I would highlight the recent increase in the VIX. And, if we go back to June and early July, the VIX was trading well below 20. Recently, we've seen that move up to the mid-20s, and obviously yesterday, a further jump in the VIX. So that was warning sign number one. Warning sign number two was obviously the very narrow rally that we've had And, as you pointed out, the heavy concentration in the rally in the NASDAQ, and most specifically in the leading tech stocks. So that narrow rally, I think, was giving us a warning. Then I think I would also argue that we've had very concentrated positions in the NASDAQ, notably from retail investors. And, that again, I think, gave us a warning. And, if you follow technical analysis, clearly the markets were looking overbought against a background of valuations looking very stretched. And, if you look at the valuation on the S&P, we're in the mid-20s, or have been in the mid-20s. Let's not forget that the last time we were here was 1999, when the price-earnings ratio reached a peak of over 25. So a number of warning signs. Where do we go from here? I think, is this the start of a major bear market or correction? I think the answer to that is absolutely no. Will we have a mini correction, which I define as 5 to 10% over the next few days? The answer is probably yes, as these reversals in the tech sector, I think, do continue. There is some momentum in this reversal. But we probably find a base somewhat lower from where we are here, and then we have a period of consolidation, which is my central case for the rest of this year.
I want to focus in, Bob, on the comparison between what we're seeing now and 1999, because you think this reversal has some legs on it. You think we could continue to see a sell-off, and on the other hand, there are some real differences between the tech leaders that we see now and those in 1999. I mean, most of the biggest FANG companies are very profitable. Almost all of them have a ton of cash. I mean, we're talking $100 billion, $200 billion in cash. That's a little different than what we saw in 1999, right? I mean, these are not just growth companies. They're also, in a sense, kind of safe haven investments.
I absolutely agree. And, I think making comparisons between sort of now and 1999 is completely wrong. And, if we look at price-earnings ratios of many of the internet companies in 1999, they were not making profits. Their price-earnings ratios, were infinite. And, the correction that we had when the bubble burst in the first quarter of 2000, we had a correction in global equity markets of 50% plus. Are we going to have that sort of correction? Absolutely not. The companies which have seen the correction in the last 24 hours, as you correctly say, are very profitable. They are under-leveraged, and actually that's been one feature of the tech sector over the last couple of years. There are very high levels of cash, very strong cash flows, and improving and good profitability. So absolutely right to say that this is not 1999. But that doesn't prevent us, having what I would describe as one of these mini corrections of 5 to 10% over the coming, let's say, 2 to 3 weeks.
Bob, thanks very much. Stay with us. Bob Parker, Investment Committee Member at Quilvest Wealth Management, stays with us on the programme. I just want to get to the GRR function, Matt, because we've got some really interesting moves coming through when you look at things from a sector perspective. It's the Spanish banking sector that's sort of saving the market from worse losses today. So GRR shows the banking sector at the top, up by just shy of 1%. And there we've got CaixaBank up by more than 9% and BBVA up by just over 3%. So there's a lot of talk about what could happen in the Spanish banking sector. It goes broader than maybe just the specifics of this M&A story. Looking at the downside, we've got technology as the second worst performing sector, real estate also in there. And remember, we've seen the capital raising coming through from Vonovia. And so that is also something that the market is mindful of this morning. Matt?
All right, coming up, it is, let's not forget, with all this market turmoil, it's Jobs Day. The U.S. labor market is seen extending its rebound. Could the U.S. unemployment rate drop below 10% for the first time since the pandemic struck? This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open. We are looking at drops here, about 0.5% on the big three equity indexes, the FTSE, the DAX, and the CAC. We see almost all European equity indexes, big and small, falling this morning, with the exception of the IBEX 35 in Madrid, which is up about 0.9% as bank stocks there rise. You also see some gains in Milan as well as Stockholm, but everything else is down this morning. Now, ahead of this non-farms payrolls report this afternoon, Bloomberg economists expect a gain in payrolls, and that the gain continues at a slower pace. So good news, but tempered, I guess. Consensus estimates predict employers added 1.35 million workers in August, though the whisper number is much lower. Right now, it's a little bit more than 670,000 expected. You can see that if you type WHIS-GO on your Bloomberg terminal. You can even put in your guess, and if you win, you'll see that you've beaten all your peers there, which is pretty cool. Bob Parker joins us, investment committee member at Quilvest Wealth Management, or he's still with us. Bob, I wonder about this slow recovery, slowing recovery that we're seeing, especially in light of government aid programs ending, a series of impending corporate layoffs. How important is this number?
I think this number is very important indeed, and it gives us a good guidance to what extent the U.S. economy will continue to grow over the next 1 to 2 months. I think the first point I'd like to make, however, is the huge divergence in forecasts for growth for the third quarter of this year in the States. And one model that I follow quite closely, as do a lot of people, is the Atlanta Fed GDP Now index, and that model is showing that third quarter growth annualized could be as high as 28%. In contrast, if you look at consensus numbers, the consensus for growth in the third quarter is about 15% annualized. So a huge divergence in range of forecasts for the third quarter. Now, my own view is that third quarter growth probably comes in annualized at around 20%, partly offsetting, obviously, the big 30% plus annualized collapse that we had in the second quarter. For the fourth quarter of this year, I think growth probably comes out annualized at about 5%. So the overall theme, if you sort of cut out the noise of short-term data, is that we've had this third quarter rebound. Most of that rebound was in July and early August. And I think there are clear signs that the recovery in the U.S. economy is now starting to moderate. I wouldn't use the word slowdown, but certainly we're still recovering, but the pace of recovery is more moderate.
And given what we're seeing in terms of unemployment at the moment, Bob, how important or not is it that we get further fiscal stimulus coming through in the US, and is it likely?
I think it is likely, but if we go back to sort of before Congress went away for the summer vacation, there was a big difference between the Democrats and the Republicans. And you'll recall the Democrats were arguing for a $3 trillion stimulus program. The Republicans were sort of talking about a $1 trillion stimulus program. It looks as though we will probably end up in the coming weeks with an agreement, probably at around $1.5 trillion. So yes, I think we will get a further stimulus program that will be supportive for the labor market, but the degree of support obviously is less pronounced than we've seen in the past. And I think one theme worldwide is that fiscal programs are being extended, but clearly budget deficits are now reaching alarming levels. So the pace of fiscal expansion, I think, has to be wound back somewhat.
Bob, I got a total non sequitur for you, but I want to get your take on European banks before we lose our time with you. We're looking at reports of a Bankia Caixa Bank all-share merger, a $17 billion deal. But how important is it that we see European bank consolidation?
Well, I think you've got a very interesting situation here, whereby the European markets are cheap relative to the US. Within Europe, the banking sector, if you look at price-earnings ratios or if you look price-to-book ratios, is super cheap. It is the cheapest sector, across the whole of European markets, and within that, Spain is one of the cheapest markets. So, that undervaluation, it's not surprising that is prompting bank consolidation. Now, given the squeeze on bank profitability and the need to cut costs across the European banking sector, I think that we will see further M&A activity. And that's a function of market valuations. It's also a function of pressure on profitability. So, I think that if you look at other markets, I think we will see further consolidation.
Bob, thanks very much. Really interesting. Yeah, we'll keep looking for that, and it's certainly having an impact on not just the businesses concerned in this M&A story, but others certainly in Spain. Bob, thank you. Bob Parker, Investment Committee Member at Quilvest Wealth Management. Thanks for joining us. Bob will be continuing his conversation with us on Bloomberg Radio. That is with Matt and I at 9 a.m. UK time. Coming up on the programme, pressure mounts on Angela Merkel to drop support for Nord Stream 2 after the poisoning of Russia's opposition leader. We bring you the latest on that story next. This is Bloomberg. Welcome back to the European Market Open. 20 minutes into a trading session here this Friday morning that comes after the sell-off on Wall Street on tech stocks in particular, and looked as if it was going in the same direction. Nasdaq futures are still weaker, but now we see the stock 600 pulling back from earlier losses. It's only down by 0.1%, and banking M&A is part of that story, at the forefront of that story, as we see the CAC Iran and the Xetra DAX back into positive territory. The IBEX up by 1.3%. We'll show you the movers and you'll see why. We've got some movement coming through in the Spanish banking sector. We have Bankia up by 28% as a result of tie-up talks with CaixaBank, which is itself up by 11.8%, lifting the rest of the Spanish banking sector as well. Barratt Developments also in focus. This is a house builder, of course, in the UK, down by 3.3%. The competition regulator in the UK is starting enforcement action on unfair leasehold terms. And in fact, this is against many in the sector, but Barratt we just put in as an example of the moves we're seeing lower. And Vonovia tapping investors for €1 billion in capital raising. We've seen Vonovia doing this and also Ryanair doing this, and Vonovia shares trade lower. Matt?
All right, German Chancellor Angela Merkel may be waiting for Russia's response on the poisoning of opposition leader Alexei Navalny before deciding how to react. She's also, though, facing pressure to drop support for the controversial Nord Stream 2 gas pipeline. Joining us on the phone from here in Berlin is Bloomberg's Germany editor, Chris Ryder. So, Chris, what are Merkel's options here? How strong is the pressure to drop Nord Stream 2?
Yeah, well, I think that's going to be interesting to play out over the next couple of days. I mean, the interesting thing was yesterday she did not repeat her position that the Navalny case and Nord Stream 2 should be separated. I mean, she was very vague. She didn't say very much, but she had made that position as recently as Friday, and the fact that she didn't repeat it yesterday is kind of, raises questions about whether Nord Stream is indeed on the table. And if Nord Stream isn't on the table, it's it's open to what they're going to do, but sanctions of some kind seem what at least on the German side, that they're pushing for.
Yeah, so an interesting change in tone there, Chris. How worried should Russia be about the response we're going to see from Germany or from Europe?
Well, I mean, on the German side at any rate, and I think across the international community, they've been pushing for hard response to the Navalny case. And Russia has pushed, blame, actually, sort of pointing the finger on Germany. They're claiming that, he left Russia without any poisoning, and then he arrives in Germany and he has poisoning. So the two sides seem very much far apart. So the key question for Germany and where this goes next is Merkel has clearly said she wants a coordinated response with Europe. And that's the interesting question because, the biggest, economic project that combines Europe and Russia right now is the Nord Stream project. That's been on hold because of sanctions on the U.S., and it's not a particularly popular project outside of Germany. So there could be a lot of pressure on Germany to, and Merkel to drop her support of it and see where they go.
Chris, when I listen to people defending the Nord Stream 2 project, they say it's really key to energy security for Germany and for Europe. Why, what is so key about this Nord Stream 2 project? Why has Merkel been supporting it for so long as she confronts Putin over so many things?
Yeah. I mean, because Germany, and effectively, actually, Merkel has put Germany's energy policy in a bind by, exiting coal and nuclear energy basically at the same time. So that means, so the long-term strategy is to go to wind and solar as the main source of energy. That takes a lot of time. There needs to be investment in the network. There needs to be a lot of investment in generation capacity. And so the reliable alternative for the time being is gas. And as Russian or as other European sources of gas, like in the Netherlands and elsewhere, decline over time, or declining at the moment, that makes Germany even more dependent on Russian gas than they would have been otherwise. So, that's the situation that basically Germany is in terms of energy policy, that they put themselves in a position where Russian gas is basically the only alternative they had. And for Merkel to try to sort of dodge this bullet effectively, she's claimed that the Nord Stream pipeline is an economic project, so she's tried to depoliticize that. And I think, but that, given the situation as it's now, is becoming harder and harder to justify.
Yeah, interesting to see whether the gap she sees between the two is closing then. Chris, thanks very much. Bloomberg's Germany editor, Chris Ryder in Berlin. Thanks for joining us. Matt, let's check out what's going on the markets right now, because things moving quick and fast, really, this Friday morning. 25 minutes into the trading session, and we're now pretty flat for European stocks. Of course, European stocks did sell off with US stocks yesterday, but we'd anticipated more selling this morning. We got that straight out of the gates as European stock markets opened to the downside. But now we see a bit of a turnaround, part of that being driven by M&A in the banking sector, but not all of it, because we see the CAC is just into positive territory now. The IBEX, though, is being lifted by some of that M&A. Let's look at the GRR function. Shows you the banking sector right at the top, up by 1.7% today, partly because we see Bankia up by 32.5% because of all of this talk and the plans they have to explore options around M&A with CaixaBank. Matt?
Up next, the world's richest tech moguls saw billions of dollars evaporate from their bank accounts yesterday. We'll talk about the drops that we see on Rich Go. This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open. We are 30 minutes into the trading day right now, and we're seeing a bit of a turnaround on, well, no, an actual turnaround on European equity indexes. Here you can see the stocks Europe 600, the broader benchmark in Europe, and we went down, obviously, at the start of trading after the U.S. posted huge losses yesterday, 3.5% on the stock, on the S&P 500, 5% on the NASDAQ. Big tech drops, but we've now recovered substantially. So the stocks Europe 600 back up into positive territory. And if you take a look at the GRR screen, the group ranked returns, you can see that banks have really been leading the rally. Let's get the Bloomberg First Word News right now. For that, we go to Laura Wright in London. Laura?
Thanks, Matt. Presidential hopeful Joe Biden visited Wisconsin yesterday. He sought to draw an explicit contrast with President Donald Trump's visit just days earlier. Biden had a phone conversation with Jacob Blake, the black man shot by police, and promised sweeping changes if he's elected in November. He said the nation is ready to make progress on racial justice. Prime Minister Boris Johnson is facing accusations of hypocrisy after speaking to a packed room of Tory MPs. Sources tell us at least 50 people were crammed into the meeting, despite a sign saying only 29 are allowed in due to social distancing. Minutes after it finished, the Prime Minister's office sent a tweet saying gatherings of more than 30 people are illegal. German Chancellor Angela Merkel is facing pressure to drop her support for the controversial gas pipeline Nord Stream 2. It comes as tensions are rising between Berlin and Moscow. Germany says it's unequivocal that Russian opposition leader Alexei Navalny was poisoned by a Novichok nerve agent. The Kremlin has dismissed calls to stop Nord Stream 2 as emotional. And there are reports from Italy that former Prime Minister Silvio Berlusconi has been hospitalized after testing positive for coronavirus. The 83-year-old has had 3 stints as premier from the mid-90s until as recently as 2011. His party, Forza Italia, has slid in the polls recently ahead of local elections in just over 2 weeks. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna, Matt.
Laura, thanks very much. Laura writes here in London. Now, a reversal of fortunes for the world's richest tech billionaires. As US equities tumbled yesterday, the most in almost 3 months, the super rich shaved over $44 billion off their personal wealth. Joining us now to discuss is Bloomberg wealth reporter Edward Robinson. Nice job to have, Edward. Let's ask about what's going on then with the latest moves. Can you talk us through these losses? Who's been hit the hardest?
Well, Jeff Bezos, of course, being the richest man in the world, suffered the biggest decline, $9 billion yesterday, and he was followed by Bill Gates at about $3 billion, Mark Zuckerberg at about $4 billion, and then on down the list. But I wouldn't feel too badly for them because Bezos is still up about $83 billion for the year.
What do you think the effect has been of retail investors? I mean, the Robinhood story has played such a huge part in, for example, the incredible gain of wealth for people like Elon Musk.
Yeah, it's really been quite a phenomenon. I think that back in April, there was a window when a lot of institutional investors and a lot of hedge funds really withdrew from the market. They went to cash, and for some strange reason that's still being studied, a lot of retail investors piled in through platforms like Robinhood. But I think that window kind of came to a close, and institutions all went back in, and your high-frequency traders all went back in, and clearly it's the big institutions that are driving the action now. But the retail guys are still there, and it's going to be very interesting to see what happens with this new generation of retail investors as they suffer, what may be like their first really big hit in a 24-hour period.
Well, it's good they got in before the institutional investors this time, but it reminds me of, the first time I played poker, I won like $700, and then I lost every week for the next 6 months until I pulled out. Ed, thanks so much for joining us. Bloomberg's Edward Robinson there talking about, Rich Go is a great way to look at the billionaires' wealth, and you can see the one-day moves, the year-to-date moves, etc. So definitely check it out on the Bloomberg. Now, the Turkish lira has weakened to a record low, and the currency downsizing is taking a toll on Turkey's inflation outlook. The lira has fallen victim to a campaign of stimulus that's consisted of steep interest rate cuts, a surge in fiscal spending, and a government-sponsored credit push, all the way down to a record low. Turning to politics in the region, tensions between Turkey and Greece continue as a small island becomes part of a flashpoint, or becomes the flashpoint in the country's competing claims to energy resources in the Mediterranean. We spoke to Turkey's foreign affairs minister, who said the nation is ready for dialogue with Greece.
This island, Mace or Castellarizo, has a critical place in the Eastern Mediterranean issue. Why? Because Greece bases its maximalist arguments on this very tiny island. And this island has a size of 10 square kilometers. And only 2 kilometers away from Turkey, from my hometown, Antalya and Kaş, and 580 kilometers away from the mainland of Greece. It is ridiculous to claim a 40,000 square kilometer maritime jurisdiction area for this very tiny island. This is the reason of the problems. when I explain this to all my colleagues, including the colleagues from European Union, from EU member states, they all agree with me. And some of them are lawyers, actually. They are telling me that Turkey is right. So if Turkey is right, why are you giving unconditional support to Greece? And that's why Greece is very counterproductive and not very constructive. And that's why we have not been able to reach an understanding. Meanwhile, of course, we showed our goodwill, and President Erdogan accepted the proposals or ideas of Madame Merkel, and we stopped our activities temporarily, of course, or suspended our activities temporarily, but Greece signed the agreement with Egypt. And this is the sign of the Greece actually real aim on the Aegean issue and also at the Eastern Mediterranean. So Turkey has been ready for dialogue, diplomacy, and to sit with everybody around the Eastern Mediterranean and to negotiate for equitable sharing. But Greece is not ready for this because of these maximalist claims at the Eastern Mediterranean. On the other hand, this island, Meis, has a demilitarized status established by the peace agreement. Which peace agreement? 1947 Paris Peace Agreement. Deployment of any additional troops is another indication of actually Greece law respecting behavior, in the region. Frankly speaking, as Turkey, we made it very clear that we will not allow such provocations at the Eastern Mediterranean or in the Aegean Sea. And if Greece continues such provocations, she will be the one suffering most. This is the message that we have been giving also. This is another threatening language. This is actually a clear message that instead of provocations, Greece.
Good morning, everybody. Hope you all right in this uncertain time, especially with coronavirus. Okay. As you can see on our ticker, we have Japanese yen. We sold short yesterday. So right now, I want to place a stop on profit. So let's do first, because the ticker show us what we hold right now. Okay, we sold, as you can see, Japanese yen at 106.253. So let's place line at 106.253. 253. Okay, it's bit. Where is it? It's right here. If anybody cautious or just concerned where I got it from, please go to our yesterday's trading sessions, and you can find exactly time when we sold it, because all our trading sessions we hold for future references. And if you will go on our channel, you can see from playlist what time, date, when exactly we open position. So in Japanese yen, we sold short at 106.253. Let's put arrow. And I'm going to place a stop on profit at 106. Let's see. Where is the 223? Yeah, it's look like it's kind of support / resistance level. So we will place stop on profit over here. It will give us it will give us exactly £300 in profit. So let's see if it will reach this level. We will sell with profit £300. If it will move slower, we will just put stop on profit to a lower price. Okay, let's follow this trade. Let's see what's going to happen.
Welcome back to Bloomberg Markets. This is the European Open. We are 41 minutes into a session where stocks have turned from red to green. Let's get the Bloomberg Business Flash right now with Laura Wright, who's in London. Laura?
Thanks, Matt. FedEx plans to hire about 70,000 seasonal workers to handle the holiday surge of packages. That's up 27% from last year. The courier has already added thousands of workers to keep up with demand as consumers order more and more online due to the pandemic. FedEx is also expanding the availability of Sunday delivery to 95% of Americans by mid-September. Two of Spain's largest lenders say they're exploring a potential merger. Bankia and CaixaBank are looking at an all-share combination, but no deal has been reached yet. Combining would help them compete for market share in a country dominated by Santander and BBVA. A merger would mark one of the largest deals yet by banks in the region. Pret a Manger is trying a new way to lure office workers back to its shops, a subscription service. It's offering as many as 5 coffees a day for £20 a month. It launches Tuesday, and customers will be given the first month free. Last week, Pret announced it's cutting 2,800 jobs and is closing 30 stores. That's your Bloomberg Business Flash. Matt, Anna.
Laura, thanks very much. Laura right there with the Business Flash. Now, the U.S. is expected to see an improvement in the number of people back in employment for a 4th month in August, when we get the non-farm payrolls data a little bit later. But the economic recovery is still tentative, and the situation is still very dire for many people in the U.S. In fact, during the pandemic, food poverty in the world's richest country has shot up, with 1/10 of American households reporting they haven't had enough food in a given week. For more on this, Jennifer Zabasaja, our Bloomberg Quick Take reporter, joins us now out of New York. Jen, the situation in the U.S. then is really shockingly dire.
Yeah, Matt, you know, even though the jobs report may signal that many people are still managing to stay afloat, the recovery is still really uncertain and not quite equal spread out. So what we're seeing right now is that experts are calling this crisis a crisis unprecedented upon another crisis that's unprecedented. The disparity between who gets to eat well, and who gets to eat at all is just growing here in the U.S. What we've learned, as you mentioned, about 1/10 of American households have said that they haven't had enough food to eat throughout this pandemic. Now, that number is more than double pre-COVID figures, and it is the highest that the government has seen since reporting began in 1995. Now, the irony of this whole situation is that we're living in a time of historic food production, not only here in the U.S., but really globally. And so farmers and the people who work for them are really struggling to figure out what to do with this food, especially with the financial costs that come with distributing it. But as a result, many Americans, many of them for the first time, are having to rely on aid and food banks, especially given that so many of them are facing unemployment and lower wages and reduced work. And especially as we've seen throughout this pandemic, minorities and women are disproportionately being affected. Especially that's notable, especially given what we've seen this summer with the issues surrounding systemic inequality. So many food banks are just concerned that as this pandemic goes on, many of the unserved and the underserved communities who have been dealing with food deserts for years are only going to struggle even more. So help is really needed right now.
Yeah, we've seen plenty reporting in Europe on similar issues, Jen. And this is a phenomenon that has plenty of resonance, thrown into stark relief by the pandemic and worsened by the pandemic, has plenty of resonance in other parts of the world as well.
Yeah, it's even more concerning when we look globally. The last report that I saw, 132 million more people this year could go hungry. That's triple a number that we've seen throughout this century. And not only that, we're seeing that more and more people in these developed and developing countries are not even able to afford healthy food. And so here's what Connie Wignarani, she is the Asia Pacific Director at the UN, here's what she said needs to happen.
One is you really tide people over on a temporary basis with a basic income that comes in as part of a fiscal stimulus package. And then you use that to really bring in and introduce longer term social safety nets, employment guarantee schemes, health insurance schemes, and other kind of more mature long-term programs. But otherwise, people are going to starve before the virus gets to them.
Yeah, so that was Connie Wignarani, and one of the things that she pointed out, actually Oxfam International is predicting that more people could die daily each day this year from hunger than from COVID-19, which is a really stark and concerning number. So the UN is projecting that this crisis is long-standing, and the impacts are going to be seen for quite some time. And it's not just the hunger that's a concern, it's also what happens as a result. Malnutrition, obesity is a result of that. Fortunately, we have seen a mobilization of many food organizations and charities coming together, but of course the need far surpasses what they're able to do. So, you know, we're far from turning the corner on this pandemic and the impacts of it.
All right, well, hopefully the more we know, the more we can do about it. Jen, thanks so much for joining us. Jennifer Zabasaja there, our Bloomberg Quick Take reporter on the hunger story. Coming up, the U.S. labor market recovery is set to continue, but likely at a slower pace. We'll look ahead to the jobs report today. Non-farm payrolls next. This is Bloomberg.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise.
The valuation discrepancy between growth and value stocks has been on the table for a while. Those value names haven't seemed to be able to hold a significant lead and come into favor where they stay in favor.
As stock prices in tech continue to go up, their volatility goes up too, which is not a normal relationship. It's usually inverse. And the fact that we, upended kind of 20, 30 years of that relationship and are starting to get that, that made me nervous.
The craziness in this 2020 summer of love for investors was getting out of hand. And then, of course, there's the Robin Hood shenanigans that have been going on. So it wasn't really a surprise.
If you have too much technology in your portfolio, this is the time to start taking a little bit of it off.
A lot of money has been made more recently in tech, so it's not surprising tech has got a little bit more of an outside downside move in here.
We are looking at a rotation out of the outperformers, sort of a blast from the past, if you will, but we are actually looking at PC stocks.
It is the beginnings of a healthy correction. We haven't really seen a dramatic pullback.
Uncertainty, as I say, is the enemy of markets.
Those were some of our guests reacting to the sell-off in tech stocks in the US. The Nasdaq suffering its biggest slump since March, but was it just a one-day event? Nasdaq futures still down, but only down 0.25% right now. European equity markets now up by 0.5%. Let's talk to Richard Jones, who joins us now, of course, from our Markets Live team. And of course, Richard, there had been some clues that this might come. Of course, if you look at options markets, put and call volumes on the Nasdaq have been exploded. In particular, I read in small lot sizes that suggest day trader interest. So do we still see signs that we could see more selling, more retrenchment in tech stocks?
Yeah, good morning, Anna. Well, I wrote a piece on stocks actually overnight, and I think as we're on jobs day, I think it's worth focusing on unemployment, and specifically worth looking at the job support programs that have been enacted in Europe, the US, and the UK, because I think over the coming months, I think the continuing uncertainty in the employment markets means that we'll probably need a big dose of additional fiscal stimulus to sustain momentum, not only in the broader economy, but also for stock markets. I mean, since the spring, we've had a huge move off the lows for stocks. Economic data has also improved in a big way. And I think it's due to this unprecedented monetary and fiscal stimulus. I think central banks have been hyper-aggressive in easing monetary policy, and there's been trillions spent on both sides of the Atlantic by governments to boost their economies. But I think despite this, unemployment remains too high, and I think it's going to require more government assistance and greater fiscal stimulus to lower unemployment. In Europe, it looks like this is going to happen. Germany announced an extension of its job support program this week, and it's backing extra deficit spending into next year. France this week unveiled an additional 100 billion euro spending plan for the next 2 years. This seems to be a realization that the economic situation remains precarious in Europe. And in the US and the UK, I think central bankers are seeing this, but politicians not so much. I think partisanship and the election cycle in the US is making additional stimulus hard to deliver, and the UK is in the process of ending its various support programs in the coming weeks. I think this makes the outlook tough for stocks in the coming months. I think stimulus has got us to where we are now, but I think more is going to be needed for any material upside in equities.
I wonder and by the way, your macro view column, Richard, I think has a great breakdown of the fiscal stimulus that we've seen, how much and where, because it's hard to keep tabs on this, right? You point out 2.9 trillion of fiscal stimulus has been enacted in the US. In Germany, only 220 billion is considered actual fiscal stimulus by Bloomberg Economics, but of course there's the European Union package of 750. So you've got these numbers here, and I wonder, as someone who follows FX for a living, what does a big fiscal package do to a currency? Because we've seen such strength in the euro and lately such weakness in the dollar.
Well, Matt, I think that's an interesting point. And the thing is, I think the euro really started to gain some momentum, mostly against the dollar, it has to be said. But that momentum was really gained once this recovery program, the 750 billion euro recovery program, the European Union program, was actually approved. I think that's when people started to realize that, okay, Europe is actually very, very serious about actually spending, about actually taking the fiscal impulse and adding it to the monetary impulse to actually support the economy. And I think the prognosis from the market is that the more that you get joined up thinking between central banks and fiscal policymakers, the better it is for the economy, and probably the better it is for the currency. I think, the ECB has actually pushed back against euro strength, and we know why they do that. But really, I think, in general, it's a good sign for the economy.
Richard, thanks so much. Richard Jones, Markets Live FX and rate strategist in Berlin for Bloomberg. Stocks in Europe then up 0.5%, doing very nicely. M&A in the banking sector helping to offset concerns around tech. Nasdaq futures still point lower. Matt and I are off to Bloomberg Radio. This is Bloomberg.
Tech tumbles. The Nasdaq closes down almost 5%. Europe pairs losses to trade in the green, and U.S. futures suggest a calmer session today. The focus will turn to the jobs report after U.S. unemployment claim figures gave a mixed reading of the labor market. Today, we'll be joined by Larry Kudlow. And no surprises, Bill Ackman tells Bloomberg market jitters are to be expected considering corporate valuations and the close proximity to a presidential election. We'll hear from our exclusive interview. Well, good morning, everyone. Welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. This is what the markets are looking at. So we did have a big sell-off in the U.S. yesterday, so we're trying to look out for any fallout here in Europe. If I'm looking at what stock markets in general are focusing on, of course, we're just hours away from that key jobs data in Washington. It's also a three-day weekend in America. And then I'm also looking at treasuries and the dollar pretty much steady in the final session. Again, before the Labor Day holiday, gold ticking higher. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. Over in the US, Democrats and Republicans plan to work together to avoid a government shutdown right before the presidential election. Sources tell Bloomberg House Speaker Nancy Pelosi and Treasury Secretary Steven Mnuchin made this informal agreement on a phone call on Tuesday. The two sides don't want the stalemate over virus relief to hold up a vital stopgap spending bill. Meanwhile, substantial fiscal aid will be needed to shore up the economic recovery. That's according to Chicago Fed President Charles Evans at a virtual event. He said the stalemate in Washington is a significant downside risk to the economy. Even with the deal, Evans is downbeat on the economy until a vaccine becomes widely available. While here, Prime Minister Boris Johnson is facing accusations of hypocrisy after speaking to a packed room of Tory MPs. Sources tell us at least 50 people were crammed into a meeting, despite a sign saying only 29 are allowed in due to social distancing. Minutes after it finished, the Prime Minister's office sent a tweet saying gatherings of more than 30 people are indeed illegal. And Greece is pushing back on claims it's negotiating with Turkey to ease tensions in the eastern Mediterranean. NATO touted the discussions to de-escalate the conflict over territorial waters, but an official says the only de-escalation Athens will recognize is the removal of Turkish ships from the Greek continental shelf. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, S&P futures are in the green this morning after the main gauge clocked its biggest plunge in nearly 3 months, while technology shares took the biggest beating in a sell-off that actually knocked down the highest flyers of 2020. Well, here to walk us through the markets action is our very own Danny Berger. Hi, Danny.
Hi, Francine. Let's call this sell-off what it is. It is a tech-driven sell-off. And yes, even though U.S. futures might be up this morning, we're still seeing pain in NASDAQ futures. This shows you that it's not a broad risk-off event. It's very much so concentrated in those frothy names. So NASDAQ futures down nearly 0.3%. European stocks also up. Again, this seems very concentrated. We're not seeing a wide breadth of a sell-off. Now, it goes back to a couple months ago, really from the March low, when we see U.S. futures, NASDAQ composite do much better than the rest of the market. So I want you to look at the green bar on this chart. That's the NASDAQ composite. We have the equal weight in blue, and in white we have the S&P 500 index. And on the way up, consistently, that green bar, the NASDAQ composite, leads on the way up. So perhaps not surprising, on the way down, the trend reverses, and that's where we get the most pain, falling about 5% yesterday for the NASDAQ. And really in there, the stocks that were the most hurt were some of these really new economy concept type names, is what Barclays calls them. So stocks like Zoom and Tesla down nearly 9 and 10% respectively. So it shows you that perhaps some of the fears over the Robinhood crowd, the very high valuations, are what caused this sell-off. Now, if we look at the next chart, where is the money going? Well, it's not going into haven. So I have the 10-year yield here in white, and you can see it's really barely moved. It's about the same level it was at the start of yesterday. So again, this is not a broad risk-off event because we're not getting a bid to the 10-year, to gold, to the yen, really. Instead, again, it's those concentrated names in tech that's leading on the way down, Francine.
Thank you so much, Dan Berger, there with the very latest on these wild rides. Now, the next big thing investors will be looking out for, of course, is today's jobs report. Bloomberg economists expect gains in payrolls to continue, but at a slower pace. Consensus estimates predicted that employers added 1.35 million workers in August. Joining us now for more is Alberto Gallo, he's portfolio manager at Algebris. Alberto, how much focus are you going to put on the jobs data to give us a path forward for the U.S. economy?
Good morning, Francine. What we are looking at is signs of a faster reopening in the U.S. economy, but also in Europe. And what we saw yesterday is that perhaps for the first time, investors are realizing that there's other assets than the top 5 companies in the S&P. And in fact, there's other assets which are very attractive and still at valuations which are close to the lows of March. Now, interestingly, this sell-off has been very isolated. It's been very focused on these large cap tech stocks in the US, but it hasn't really impacted, for example, Europe, or energy shares or financials, or all the things that really would benefit from a return to normal. And I think markets are being slow to price this return to normal. We have a $5 test, and that can really help businesses to go slowly back to normal over the coming months. And that's where we're putting our money.
Where will the biggest scarring actually come from in the U.S. economy, Alberto, and what does that mean for future returns?
There is a lot of scarring in the real economy. There is, in some segment of the population, up to 20% of households which are struggling to get food. There is a lot of social injustice, a lot of inequality in the way growth has been distributed. And the reason is also that the central bank focused policies of the last 10 years have been very focused on pushing asset prices up. And only the top 10% of Americans own stocks. The top 10% of Americans own 90% of the equity. So what we need to see now is more bottom-up, more Main Street driven policies which encourage higher minimum wages, investment in productive areas of the economy, and a rebalancing. Will we see it in the future? It will depend on the result of U.S. elections. If we see a shift to the Democrats, then we will see a more balanced growth story, and we will see maybe slightly higher inflation and a more balanced stock market as well, with not just 5 companies leading the market. If we see a continuation of the Trump administration, we probably will see more of the same. I think in any case, it's important to look at non-U.S. assets because the valuation gap is very high. U.S. assets are expensive, and the U.S. growth story may not be as strong as in the past. And Europe just got its act together with the recovery funds. We have a fiscal union, and there's a lot more upside, I think, in Europe with the coming policy measures.
Alberto, is this despite more upside in Europe despite a possibility of actually not finding an agreement between the UK and the EU on Brexit?
That's a good point, and Brexit is still an elephant in the room, but it's a smaller one because we think that the some of the alternatives may not be as bad as in the past. There is some more preparation on both parties, and even in the event of a no deal, I think some of the essential services, the cliff edge, may not be as bad as as it was 1 year or 2 years ago. Clearly here, the UK economy, which has been too focused on services and European exports, is the one that is gradually at a loss. So I think there's still an incentive for a deal or for a delay, a procrastination. That would be our base case scenario, that there is a soft deal, not a perfect deal or an extension. But we are quite cautious on UK assets going into the end of the year.
Alberto, when you look at euro strength, when is that going to be problematic for the region?
So here, the real question is which central bank is going to lose the currency war? We are in an environment where central banks and governments are using currencies to prop up their economies and to try to solve problems that are not solvable with currency printing. Now, the ECB is more conservative, and Mr. Lane made a warning shot the other day saying that the FX matters, but the reality is the ECB will be pushed to do more, but has less weapons, less room to maneuver compared to the Fed and the Bank of England. So we see the euro going higher, and we see the dollar going lower. We see gold also going higher in a race to solve real economic problems like inequality and social injustice with central bank one-size-fits-all tools, so with QE or helicopter money. That's where we're going. So for investors, we need to defend capital from the debasement of fiat currency. So we're investing in real assets. We're looking at yields which are much higher than where inflation may be. We're looking at gold. We're looking at real estate-linked assets. It's an environment where the typical nominal return of a government bond is the worst thing you can have. You're getting 0.5 or 1%, and inflation can easily be above that.
Yeah. Alberto, thank you. Alberto Gallo there from Algebris stays with us. Now, coming up this afternoon, we'll also be speaking to Larry Kudlow after the U.S. jobs numbers come out. Make sure you catch that interview with our Jonathan Farrow. This is Bloomberg.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, after yesterday's steep sell-off in the U.S., let's check in on the markets. So this is what we're seeing in Europe. You can see European stocks gaining some 0.4%. Of course, the focus today is firmly on what's happening with U.S. jobs. So we are getting that a little bit later on. U.S. futures actually fluctuating. European stocks were fluctuating, and now they seem to be stabilizing a little bit. Treasuries and dollars steady. Again, it's the final session before the Labor Bank holiday in the U.S. We did see these moves into haven assets more muted than yesterday, despite the pronounced drop in equities. I'm looking at gold. It's actually ticking higher. Now, ahead of the ECB's new forecasts next week, a Bloomberg survey shows that economists expect the central bank to keep its outlook unchanged and to step up its crisis response later this year. This comes as German manufacturing continued its recovery in July, albeit at a dramatically slower pace, and demand jumped 2.8%, less than the expected 5% gain. Well, Alberto Gallo from Algebris is still with us. Alberto, ever the optimist on Europe. You say you prefer Europe to certainly the U.S. What are you expecting from the ECB?
We expect an expansion of the purchase program. We think that calls to rein in emergency funding, which have come from the Bundesbank, for example, are very premature. We still see that the recovery is fragile. We have seen PMIs dipping towards 50 or slightly below 50 in some countries. The post-crisis bounce that we had was very mechanical. Now we need this bounce to be sustained. We need employment to come back to a lot of the sectors which have lost jobs. And we think the ECB will continue to be supportive. However, the ECB has less ammunition compared to other central banks, which have become a bit less independent and are more pushed by their respective governments, like the Fed or the Bank of England. And I would say here that the euro continues to go higher because it is a currency where the central bank is more conservative. So can we see the euro going above 120? Yes. So the euro will continue to be something that will cap a bit of upside in European assets on the equity side. However, in credit, which is about the survival of companies, we still see very, very interesting yields across European companies, particularly in the sectors which are linked to the cyclical economy, like banks, for example, or the tourism industry, which, by the way, still also gets good government support. So we're lending to these companies, to these banks, and we're getting paid a lot higher than you would get paid by buying a Spanish or Italian government bond.
Alberto, I mean, when you look at some of the bonds, what happens to, fixed income in Europe? Where, I mean, you mentioned, some of the things that maybe you find attractive. What is the least attractive, European bond out there?
The least attractive thing you can do today is to buy the same things that central banks are buying. So, for example, buying a long-end treasury, buying a investment-grade bond yielding less than 1%, buying a long-end BTP yielding less than 1%, not because you're going to lose money quickly, but you're going to definitely lose money against any little rise in inflation. And you also know that if there is a crisis, central banks will use more ammunition, will essentially print more money, and that currencies may depreciate, particularly the dollar. So what you want to have is a mix of assets that yield more than inflation, so that yield at least 3, 4, 5%. You want to have some gold because you know that it's the only currency that can't be printed. And you want to have some equities which are linked to a recovery, which are still cheap. The $5 test developed in the US can really help certain businesses to keep running, or at least run at over 50% capacity, and therefore, recover a lot of the value that has been lost in the equity market. And there is a lot of stocks besides, Tesla and Apple and Google, which are cheap around the world.
Alberto, thank you so much. Alberto Gallo, their portfolio manager at Algebris. Now, coming up, how fragile is the underlying recovery? We take a look at how food poverty has worsened during the pandemic. That's next, and this is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, the U.S. is expected to see an improvement in the number of people back in employment for a fourth month in August when we get payroll data later today. But the economic recovery is still tentative, and the situation is still very dire for many people in the U.S. In fact, during the pandemic, food poverty in the world's richest country has shot up, with a tenth of American households reporting they haven't had enough food in a given week. Well, for more on all of this is Jennifer Zabazaja, our Bloomberg Quick Take reporter who joins us from New York. Jen, this is so extremely important. People forget how tough it is for certain citizens.
Yeah, Francine, you know, while the jobs report may signal today that some people are managing to stay afloat, the recovery is really presenting to be quite uneven for millions of Americans. There's still a great divide over who eats well, and who goes hungry in this country. Now, as you mentioned, experts are calling this an unprecedented crisis upon crisis. They're saying that about a tenth of American households are reporting not having enough food throughout this pandemic in a given day to feed their families. That number is more than double pre-COVID figures, and it's the highest number reported since the government began tracking this back in 1995. And it's even expected to grow as the pandemic goes on. Now, the irony of this whole situation is that we're living in a time of historic food production, right? Not just here in the U.S., but globally. But food supply has, of course, been disrupted due to coronavirus lockdowns, forcing farmers and the people who work for them to make really difficult decisions about where this food goes. And as a result, many Americans are having to, many of them for the first time, rely on food stamps and food aid to get their meals while dealing with things like unemployment and lower wages and reduced working hours. And like we've seen throughout this pandemic, it's exacerbated along racial lines. Minorities and women make up a majority of those people fighting through food insecurity, and it's only expected to get worse. So food banks are just concerned about how this plays out as the pandemic goes on, especially for those unserved and the underserved communities that have been dealing with food deserts and food insecurities for so many years now. Francine?
Jennifer, what's the picture like in the rest of the world?
Yeah, I mean, it's even more concerning globally. 132 million more people could go hungry this year as a direct result of the pandemic. And as I mentioned, you know, with food supply disrupted, food prices are going up, not just in the developed world, but also in developing world. So here's what one UN director said about what needs to happen.
One is you really tide people over on a temporary basis with a basic income that comes in as part of a fiscal stimulus package. And then you use that to really bring in and introduce longer-term social safety nets, employment guarantee schemes, health insurance schemes, and other kind of more mature long-term programs. But otherwise, people are going to starve before the virus gets to them.
Yeah, so that was Connie Wignerana talking about that. And what she's referring to is Oxfam International predicts that more people this year could die per day from hunger than from COVID-19, and it could only get worse. You know, and with millions of people out of work and not being able to afford a healthy diet, malnutrition and obesity is also a concern. And so, you know, Francine, I guess the one bright spot of this all is that food organizations and charities have really mobilized to try and help some of these places that you saw on that map and those families in need. But we're far from turning the corner on this pandemic and sort of the impacts that we're seeing as a result.
Jennifer, thank you so much. Extremely important, of course, news item that we'll talk a lot more on. Jennifer Zabazaja there, our Bloomberg Quick Take reporter. Now, coming up, reskilling for after the recession. We'll also co-founder of the company behind Candy Crush, why he's backing a new way of teaching coding. That's Bloomberg.
another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Over in the U.S., presidential hopeful Joe Biden visited Wisconsin yesterday, and he sought to draw an explicit contrast with President Donald Trump's visit just days earlier. Biden had a phone conversation with Jacob Blake, the black man shot by police, and promised sweeping changes if he is elected in November. He said the nation is ready to make progress on racial justice. Now, German Chancellor Angela Merkel is facing pressure to drop her support for the controversial gas pipeline Nord Stream 2. It comes as tensions are rising between Berlin and Moscow. Germany says it's unequivocal that Russian opposition leader Alexei Navalny was poisoned by a Novichok nerve agent. The Kremlin has dismissed calls to stop Nord Stream 2 as emotional. France may extend its furlough program beyond the end of 2020. Speaking on French television, Finance Minister Bruno Le Maire indicated the government is ready to spend more than 100 billion euros it unveiled earlier in the day. Le Maire says if the crisis gets worse and they need to do more, they will. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now let's get a market update. Yesterday saw the S&P fall 3.5%, while the tech-heavy NASDAQ plunged at 5.2%, its biggest drop since March. Now let's get more with our Bloomberg MLive macro strategist, Laura Cooper. Laura, how's Friday shaping up on the equity markets?
Well, I think, really when we saw yesterday, there was no obvious catalyst for the sell-off, likely some profit-taking ahead of payrolls. It came after this relentless tech rally. And what we're seeing in today's early price action is that we're seeing this buy-the-dip mantra actually take hold. So European equities are back on firm footing, and we've also seen U.S. futures climb back. And it just remains the tech sector that remains fairly weak on the back foot. So certainly today, payrolls will be the key focus for markets, but what we're seeing already suggests that yesterday was not the start of this rush for the exits in terms of risk appetite.
Laura, what are the markets focusing on right now? I mean, what exactly, brought on that sell-off in NASDAQ and valuations in tech?
Well, I think really there was no obvious catalyst. I think it's largely the case of, investors are focusing on these frothy valuations and likely taking some profits from these outperformers. Because even if we look at kind of outside of the tech space, there was some relative bright spots in terms of those cyclical outperformers in Europe. So I think really there were some warning signs that this was due, whether that's the frenzy that we've seen in the options markets or just this divergence that has emerged between volatility gauges and equity indices. So I think at this stage, really, it's more a case that markets are just going to kind of go back to what's been driven it so far is just this upbeat data prints, this vaccine optimism, and ultimately the fact that these monetary policy accommodation conditions have not yet, they're not being tested. And then as well, fiscal stimulus, markets remain priced for something on that front. Really, at this point, those conditions have yet to be materially changed going at this stage.
Laura, thanks so much. Our Laura Cooper there, Bloomberg MLive macro strategist. Now, service sector jobs have been hard hit in the current crisis, particularly affecting employment for younger people. So how can they gain skills to work in the industries of the future? Well, my next guest.
We closed position on Japanese yen at 106.223. We have a profit, 300 pounds.
250 students. Well, we're delighted to be joined by Riccardo Zacconi, co-founder of mobile games company King, who joins me. Riccardo, thank you so much for giving us a bit of your time for something that you're doing, which is really important, which is teaching young people to code and to code for free. You know, what spurred this initiative? Are these the jobs of the future?
I think so. I think the key reason for the initiative was that I think there is a massive problem in the economy. I think that digital can help a lot. If you look at the value creation on the stock exchange over the last 30 years, I think something like 90% of the increase in market value has been from tech companies. And I can also talk about my experience. We were 6 guys when we started the company, when we started King. And 6 people, we created a company that has more than 2,000 people and was generating more than 2 billion in revenues and 40% of EBITDA. So with this in mind, I received many emails from many people saying, I have a brilliant idea. Can you help me to realize this idea? I don't know how to code. Can you please help me? And of course, you know, the idea is only one element, but you need to know how to realize the idea. And so from this, I was looking for how can we change the situation, in particular in Italy. So together with my former university, Luis, we are now launching in January the 42roma.it, which is a free coding school. The innovation in this is really that it's accessible to anyone. So there is no prerequisite in terms of having done university or having done specific schools with top degrees, et cetera, et cetera. The only prerequisite is to be between 18 and 35 years old and to pass an IQ test, so a logic test. And it's a very hard test.
Are you worried about some of these jobs? You know, this is, you know, really important and the core of our society. It's making sure that people have jobs and actually have the right skills to do the jobs of tomorrow. Do you think the job market will change significantly because of the pandemic?
Well, it will definitely change significantly because you can see now that if you don't have the possibility to serve your customers where they are, and with the digital, and digital really is key, I think you lose out. You can't serve your customers. And the school has 3 important components. So one component is to basically teach to code, but then we also are bringing on board supporters. We're bringing on board the top digital companies in Italy to offer internships, to integrate the school in the recruiting program. And we also are building a network of supporters in Silicon Valley who can basically mentor the students in the school. The target is not just to bring people, to teach people to code, but is really to place them in the best companies in the world in digital so that they can really learn not only in the school, but also on the job. And hopefully we can have many more very successful founders on a global scale coming out of there.
Riccardo, do you feel now that Italy is actually losing in part of that race of being more digital?
Well, Italy, if you look at all the statistics, Italy is very much at the bottom of the ranks in digital. We have some amazing people. You know, my belief is that the percentage of smart people is everywhere the same. It doesn't matter where, in which country, in which race, which gender, etc. So if there is an underrepresentation, for me, there is a huge opportunity. There's a huge potential. And I think, for example, also it's an opportunity to bring on board more female. I think females in general also underrepresented in digital. And this is really my target. I think this school is a fantastic opportunity. The school is extremely focused on creating skills that are useful. Not often you come out of university and you still don't know what to do, and then you learn on the job. No, this is a school which is really focused on teaching you how to do things, so that when you are out of there, you know how to do something. You really can develop a product at the standard which is able to compete on international level.
Riccardo, how digital do you think the world will become? We were just talking about some of the valuations in some of these tech companies that are really taking over. I mean, I'm sitting in a studio in London. You're at home. We're doing this via Zoom. Has the lockdown really accelerated the digital trends? that would have happened in 5 years? Have they accelerated them by 2-3 years?
I think the lockdown has accelerated a few things, has accelerated some issues in the global economy, really exacerbating companies that were not doing well before. Now they're really brought to the limit. And on the other hand, has also given an incredible boost to companies that are digital, that can serve their customers where they are, rather than having the customer having to go to the company. And you can see this. I mean, in my area in games, all gaming companies are doing extremely well. People have more time to consume digital offerings, but people also want to be served where they are. They order now their food at home, etc. So I think digital now is not anymore. There's not anymore a tech sector and non-tech sector. I think every industry now needs to embrace digital.
What are you doing next, Ricardo? Are you up for like another big challenge? Are you going to build something?
Well, I think I have at this moment in time, I have 3 key things. One, I set up a fund. It's only our money where we help entrepreneurs to succeed. It's called Sweet Capital from Candy Crush. The second thing I'm doing is this project, which is for me extremely important. I really want this school to succeed. And the third thing I'm doing is I set up also a charitable foundation to invest in development of therapies for rare children genetic diseases. And then the fourth thing is I'm taking some time off also for the family, but to think what else. I still have a feeling I want to do something else still, but I need a bit of time.
Okay, Ricardo, understood.
I want to do.
Yeah,
I want to do. Yeah, but it's. Go on.
No, please continue.
But I want to do something that has an impact. So for me, I think it's when you are in a lucky position to have had, to have succeeded in something that you wanted to achieve, I think you need to give back. And so for me now, a key part in what I want to do is really to help others also to succeed. And I think that I'm very worried about the current economic crisis that I think is long term. And so I'm trying to do try to help a bit on this and try to change a bit the world and live it a bit better than before.
Wise words. Riccardo, thank you so much for joining us. And don't be a stranger. You have to come back on TV very soon. Riccardo Zacconi, their co-founder of King, joining us today. Now, before we head to break, after yesterday's sell-off in the U.S., let's quickly check on the market. We're going to do extra market checks today. So what we're looking at is, of course, a lot of the focus. So markets, first of all, have stabilized compared to what we saw yesterday with the huge NASDAQ sell-off. But overall, the fluctuation that we saw in U.S. futures is still continuing, and then we're just hours before some key jobs data in Washington, and of course, a 3-day weekend in the U.S. So we'll have plenty more on the markets shortly. This is Bloomberg.
valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise.
The valuation discrepancy between growth and value stocks has been on the table for a while. Those value names haven't seemed to be able to hold a significant lead and come into favor where they stay in favor.
As stock prices in tech continue to go up, their volatility goes up too, which is not a normal relationship. It's usually inverse. And the fact that we, upended kind of 20, 30 years of that relationship and are starting to get that, that made me nervous.
The craziness in this 2020 summer of love for investors was getting out of hand. And then, of course, there's the Robin Hood shenanigans that have been going on. So it wasn't really a surprise.
If you have too much technology in your portfolio, this is the time to start taking a little bit of it off.
A lot of money has been made more recently in tech, so it's not surprising tech has got a little bit more of an outsized downside move in here.
We are looking at a rotation out of the outperformers, sort of a blast from the past, if you will, but we are actually looking at PC stocks.
It is the beginnings of a healthy correction. We haven't really seen a dramatic pullback.
Uncertainty, as I say, is the enemy of markets.
Well, those were some of the guests talking yesterday about the sell-off and the biggest rout since June. That's what we saw yesterday. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. FedEx plans to hire about 70,000 seasonal workers to handle the holiday surge of packages. That's up 27% from last year. The courier has already added thousands of workers to keep up with demand as consumers order more online due to the pandemic. FedEx is also expanding the availability on Sunday delivery to 95% of Americans by mid-September. Now, the Justice Department reportedly plans to file antitrust charges against Google in the coming weeks. That's according to the New York Times. The paper says Attorney General William Barr is trying to expedite the case. Lawyers involved with the antitrust inquiry have been given a deadline of the end of September. Many of them oppose that, and some even left the case. And Pret a Manger is trying a new way to lure office workers back to its shops, and that's a subscription service. It's offering as many as 5 coffees a day for £20 a month. It launches on Tuesday, and customers will be given the first month absolutely free. Last week, Pret announced it's cut 2,800 jobs and is closing 30 stores. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Now, voters shut out from the polls because of long lines, mail-in ballots not received in time, a general lack of confidence that the election was conducted fairly. Bloomberg Business Week looks at the worst that could happen in an extremely volatile election year.
The coronavirus pandemic has greatly increased the chances of something going awry in the November election. Millions more Americans will be voting by mail because of the virus, but some of those ballots may arrive past the deadline to be counted. The campaigns could then head to court to argue over whether to count those ballots, or the candidate who is ahead on election night could sue to stop the counting. If the election is closed, that could mean that a judge's decision on which ballots to count would determine the winner. But that's not actually the weirdest scenario. If a key state's election is not decided by the time the Electoral College meets, no candidate would have more than the 270 electors required to be a majority, sending the decision to the House of Representatives. It gets weirder from there. Under the rules, each state delegation only gets 1 vote for president. Because of gerrymandering, the House majority may not have enough votes to pick its favorite candidate. The Speaker might decide not to vote at all, while the Senate forges ahead on a separate vote on Vice President. When the president's term ends on January 20th, the line of succession kicks in. Say hello to President Pence or President Harris.
And you can find that and more in a special issue of Bloomberg Business Week on newsstands now. I survived a voter's guide to the most volatile election in decades. Now, coming up, we'll hear from billionaire investor Bill Ackman on the current market volatility and high valuations in the U.S. That's coming up next, and this is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, Bill Ackman of Pershing Square Capital Management told Bloomberg that the market uproar we saw yesterday isn't surprising given the current uncertain landscape and high valuations in the U.S. Take a listen.
Not the beginning of the end, but I would say we're coming upon one of the more uncertain periods in American history, right? We have a very divisive presidential election coupled with, a virus that's had a huge impact on the economy. And the markets have been remarkably strong since really the third week in March. And so it's not surprising. Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty, and we have an election in 60 days where it's a toss-up who's going to be the next president and what the policies of the next president, whether it's Trump's second term or Biden's first term, what that means for the country, what it means for corporate America, what it means for taxation. These are uncertain issues, and uncertainty, as I say, is the enemy of markets.
You had said that it wouldn't change your investment position no matter which person was to be president for the next administration. Are you changing your thoughts on that now? Do you think there would be widely different policies were there to be a Biden administration, for example, rather than a second Trump term?
I don't know that it's completely knowable. I think Biden and his choice of a vice president suggests a more kind of moderate as opposed to more progressive Democratic administration, to the extent that Biden is sort of the winner. But I do think they're going to have different policies and different approaches toward, taxation, business, et cetera. Although I do think Biden, Kamala Harris is in a more moderate camp than a Biden, Warren administration, for example.
I do want to push you a little bit on valuations, because you mentioned how things had maybe got a little fully valued or overvalued, but a DocuSign down 12%, Tesla down 8% today. Is that closer to sort of the real valuation for these companies, or a fair valuation in this environment? Or, could there be even a lot more to go?
So I don't know enough about either of those two businesses to know whether the price is a fair price or not. But a lot of, I would say, when I speak about valuation of some of the more high-flying companies, a lot is predicated on what's going to happen in the future, right? What's interesting is when you have a world with almost 0% interest rates, the discount rates used to discount the future are very, very low. And so with companies which are growing very rapidly, low discount rates, rapidly growing companies, you can get to very high valuations. Although the problem is small changes in your assumptions can lead to a very different outcome in terms of what a business is worth. And I think those small changes in assumptions can relate to someone's confidence in what the future looks like. And I think it's hard to predict the future when we have an uncertain sort of political environment and just the inherent uncertainty about the virus. Yesterday, CDC tells states to prepare for, possibly a distribution of a vaccine November 1st. If there's a real vaccine that's distributed in scale before the end of the year, that has a meaningful impact. If there isn't one until the second half of next year, that has a meaningful impact as well. I just think it's not known today, what those outcomes are, and you factor in. Your risk premium, should go up when there's more uncertainty. And the risk premium relates to the discount rate. It's the risk-free rate plus a risk premium that you use to discount the future. And many rapidly growing companies, you can't justify the value placing a multiple on next year's earnings, which is sort of the convention for many kind of more mundane businesses. You have to make certain expectations about a company's ability to become profitable and for those profits to grow at a pretty rapid rate to justify many of the values or the collective values of where many of these companies were trading. And I think that inevitably leads to more volatility when there's uncertainty.
Well, that was Bill Ackman of Pershing Square Capital Management. In the meantime, this is what the markets are looking at today. Now, yesterday there was a big sell-off in the U.S., NASDAQ, but also S&P. If you look at Europe, actually making a short work of the U.S. tech correction. If you look at markets right now, they're gaining. I'm also looking at a couple of other things. So the S&P 500 futures, you can see, are fluctuating a bit, but 0.3% higher. And then Treasuries and the dollar really steady in the final session before Labor Day, and of course it's Jobs Day as well. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television. Tech tumbles. The NASDAQ closes down almost 5%. Europe pairs losses to trade in the green, and U.S. futures suggest a little bit of a calmer session today. The focus will turn to the jobs report after U.S. unemployment claim figures gave a mixed reading of the labor market. Later today, we'll be joined by Larry Kudlow, and no surprises. Bill Ackman tells Bloomberg market jitters are to be expected, considering corporate valuations and the close proximity to the presidential election. Well, good morning, everyone. This is Bloomberg Surveillance. I'm Francine Lackley here in London. Tom Keene in New York. Tom, it's all about NASDAQ. It's all about that sell-off that we saw in tech. And it's, of course, a U.S. jobs day will give us, we hope, a clearer picture of what the economy in the U.S. is actually facing.
Clarity would really be needed here. It was absolutely remarkable, Francine, yesterday to see the analysis off the claims report. And I'm going to go with Economic Policy Institute down in Washington. It was pretty grim when you sum in all the pandemic unemployment as well. We'll see at 8:30, but on the equity markets, it's just simple. As Kit Juke said this morning brilliantly, it's non-correlated. It was very discrete to the stock market versus foreign exchange. We'll do that in the data check coming up.
Yeah, we will. Longer data checks today. Now let's get straight to the Bloomberg First Word News in New York City. Here's Karina Mitchell. Hi, Karina.
Good morning. Republicans and Democrats have agreed on one thing. Treasury Secretary Steven Mnuchin and House Speaker Nancy Pelosi are working to avoid a government shutdown right before the election. They won't let the stalemate over virus relief legislation hold up a vital stopgap spending bill that clears the way for the government to stay in operation at the start of the new fiscal year. President Trump has denied a magazine account that he disparaged America's war dead as losers. According to The Atlantic, the president tried to get out of a visit to the graves of American Marines killed in World War I in France. He reportedly said, quote, "Why should I go to that cemetery? It's filled with losers." The president calls the account a total lie. And the suspect in the shooting of a right-wing activist in Portland, Oregon last week has been killed. Federal authorities say they were trying to take Michael Reinhold into custody when officers shot him. Reinhold was a vocal supporter of the far-left Antifa movement. And the U.S. labor market probably saw a fourth month of improvement in August, but chances of further outsized gains are diminishing without the stimulus payments. The monthly jobs report is out at 8:30 New York time this morning. Economists project the unemployment rate drop below 10% for the first time since March. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Karina, thanks so much. Greatly appreciate it. Equities, bonds, currencies, commodities. What you do, folks, you look at the Bloomberg Launchpad, and you it's a blur of numbers, and you try to see within the blur the correlations that are out there. And the number one message is last night's debacle was not correlated. Futures bounced this morning, as Francine mentioned, up 13. Dow futures up 150. The VIX comes in a full stick from a 33 level into 32.34. To review, we were at 21 and then 24 and exploded out yesterday to the 33 level. The real yield barely moves, which speaks to the nominal and inflation. But as Kit Jukes mentioned, Francine, the foreign exchange market was shockingly stable yesterday. Some equity strategists would suggest equities delinked from the rest.
Tom, a couple of things I'm watching. So you said it beautifully, that it's the non-correlation that we need to look at. I'm looking at gold, higher touch, treasuries, and the dollar pretty much steady. And then the stock 600 was actually fluctuating. And then, we saw losses, and that initial loss then was erased because banks, especially in Spain, are gaining on a potential merger between the two biggest lenders. So just an added story that we need to look at. Now, to look at your markets, non-correlation, and of course, what happened in equity stocks, especially NASDAQ. Let's get straight to James Athey, Aberdeen Standard Investments Investment Director. So, James, as always, thank you so much for coming on to try and make us smarter. What did you see in the markets yesterday? I mean, the non-correlation point of Tom is interesting. What's underlying the sell-off that we saw yesterday?
Yeah, morning, Francine. Yeah, I think that's absolutely the right and an astute observation. Treasuries, down a basis point. The dollar actually a tiny bit weaker. Other equity indices across the globe not really reacting with anywhere near the same force. That tells me straight away there's not really a macro driver underneath all of this. It looks like it was a very technical event. Actually, what we've been noticing in the days leading up to this was some really funky looking things going on under the hood, not just in the broad indices, but specifically in that kind of group of tech names that we all know about, and specifically actually in the options market, where it looked like there was a bit of a self-fulfilling loop going on, where heavy option buying from end users was essentially driving the dealers who were short those options to then delta hedge by buying the underlying. That was spilling over from single names into the broader indices. And so you saw things like the broad index going up on the same day that the VIX was going up. You saw things like implied volatility in the NASDAQ rising faster than S&P implied volatility, such that that spread was as wide as it's been in a very long time. And I think what happens then is the end user buying stops of those options, and you just get this air pocket. And I think that's what we saw yesterday. So very technical. I certainly wouldn't ascribe any macro narrative to it.
So James, can you, I mean, so this is basically what a removal of froth, right? It's not, if there were a warning sign, where would you see it?
In terms of where we go from here, you mean, or looking at yesterday's move?
Just in general, if something, were to turn ugly in the market as a whole, where would you see it first? Where would that warning sign be?
I mean, you'd have to look first and foremost at big tech, I think, because again, the divergence between big tech and U.S. indices, between U.S. indices because of the tech weight and broader indices has been obviously a feature of this market now for quite some time. And so I think in order to see a real shakeout, first and foremost, you'd have to see some further really negative performance from big tech, knowing that that's been a popular position, and a popular position really amongst a broad range of investors, but also because concentration in the broad indices has been getting so high, even passive investors who are just buying broad index are heavily exposed to tech. Yeah. So if you were to see that start to unwind, I think that would be my first indicator that we might see something a bit more long-lasting and a bit more brutal.
Yeah, James, I really like that idea of the effect on passive investors like the big index funds, folks, and we're not there yet. Smartest note I've seen in the last 12 hours, Michael Purvis at Tallback, and let's take a look. This is a brilliant note. No surprise there. Purvis is just that good. The retail frenzy in big cap shares and call buying does not imply a broader market complacency. He goes on through a lot of math and ratios off NASDAQ and put call to say as well, days like today might feel like the beginning of a massive bear market, but we think it more accurately is simply a reflection of investing and trading in highly financialized markets. James Athey, the reason you're here is you're expert on this. How financialized is your world where derivatives have taken over the cash market?
Yeah, I mean, financialization, it sort of means subtly different things to different people, but broadly speaking, I agree with that sentiment entirely. It is not just about the instruments that are being used by investors and speculators and traders, such that, as you say, derivatives dominate the cash market, the types of strategies which people are engaging in, which heavily use derivatives, but it's also the behavior of the companies themselves and the extent to which their business model has become financialized. And by that, I mean they are borrowing to invest in their own stock. They're not borrowing to invest in their own businesses. And that has been a feature of the market for a number of years, and that's helped to propel equity markets ever higher, such that it reinforces that market psychology that equities can only go up, valuation no longer matters.
To go to the clinic of William Ackman that we saw yesterday on Bloomberg, and James Athey, again, you and Bill Ackman, I'm sure, are on the same page on this. The fundamental financialization is the artificiality of the bond market, which leads to no clue what the risk-free return is, leads to no clue how you stabilize through the fixed income market over to some form of ratio valuation of equities. How blind are we going into the end of the year?
Yeah, completely, absolutely. I mean, the bond market, I wouldn't say the bond market is more distorted than the equity market, but the bond market is the direct means that central banks have, first and foremost, distorted markets, and then relative valuation sort of, flows out from that distorted value. So I completely agree. Price discovery, the notion of capital markets as disciplinarians, vigilantes, if you like, all of these concepts have gone completely out of the window. The psychology of markets is, broadly speaking, a trader's psychology, always and everywhere at the moment. We're really not, as a community, the investor community is really not engaging in attempts to derive fair value, and that obviously includes treasury bonds and sovereign bonds as well. It is more a question of stimulus. What are the actions of the central banks? What are they distorting? How much are they distorting it? And therefore, where am I being incentivized to essentially take risk regardless of the price and of the value?
Will we ever, James, go back to old school correlation?
I think we will. I think it's, we all, humanity, humans, just cognitive bias, we have a tendency to believe that, what is true today will continue to be true. It's called the status quo bias. And we have short memories. In reality, monetary policy has not always operated this way. We go through, periods, paradigms, if you like, where monetary policy operates in a certain way, and then reality exerts itself and we have to reassess. And I think, in the next few years, there's going to have to be a massive and fundamental reassessment of exactly what monetary policy is trying to achieve and how it's trying to achieve it. And when that occurs, that absolutely will change some of these relationships between markets. That also being said, I do believe there is a limit to which markets can continue to sort of pay up, if you like, ignore the premium that they're paying for future cash flows, just purely because they believe that there is a central bank there to support them. So I think there's a number of events and a confluence of those events which are likely in the coming years. I think it's possibly likely that inflation is the main, most obvious trigger for that to occur, because central banks are limitless in their actions unless and until we get inflation which is above their tolerance. And at that point, you have to reconsider whether central banks can continue to provide stimulus, and that might not be good for assets just in general, as we saw in 2018.
James Athey, thank you so much. A terrific brief at the top of the hour here. Mr. Athey, of course, with Aberdeen Standard Investments. Yes, we're looking at the markets with futures up 11, Dow futures up 140, but even more so to 8:30 this morning in the labor economy of America. Without question, in my career, this is the greatest mystery, the single greatest month of deep mystery. Jonathan Farrell will get perspective from Mr. Kudlow of the Trump administration. Look for that in the 10 o'clock hour. Stay with us. This is Bloomberg. Good morning. Good morning, everyone. Bloomberg Surveillance. What you need to know in the American 5 o'clock hour, London mid-morning, as the markets stabilize off the carnage yesterday, away from the equity markets, futures up 11. You see some real stability in foreign exchange, real stability in the bond market as well. That stability is awaiting 8:30 this morning. Stephen Blitz is with T.S. Lombard, the British shop, but he is our chief U.S. economist and will describe the mystery this morning. Steve Blitz, what's the greatest mystery as you go into this report?
Well, the greatest mystery is how we keep creating 1.5 million net new jobs when you get initial unemployment claims total around 4 to 6 million in the same 1 month period. So if you just do the simple math there, you're adding about, about 8 million or so grossly, new jobs. And that's a mystery, but these things get solved over time.
Well, they get solved over time, and there's the old TV show line, this does not compute. Well, let's compute it right now. Heidi Sherholz at Economic Policy Institute was brilliant yesterday, combining the published claims number with the pandemic-adjusted claims from all the different federal programs. Are you going to have to go through that exercise this morning of taking the normal report and adding in other data?
Yeah, but you know what? Truthfully, there's only one number I'm really keying in on,
What's that?
That's the number of people who say that the jobs that they lost were a permanent job loss, and that number has crept up, and it's just under 4 million. It didn't move much last month, and that's at a mild recessionary level, and that number peaks at the end of a recession. It's not at the beginning. So you've had this, as we know, this temporary job loss, which is what the big surge was back in April. The temporary number has come down, is what's come down a lot as the economy's reopened. It's the non-temporary number, so to speak, that's crept up. And that's the number that's going to indicate, when we get into the fourth quarter, what kind of economy, what kind of growth we're really going to have. And we know the third quarter is going to be 20, 25%, something like that. Can you repeat a 4, 6, 8% kind of growth rate in the fourth quarter? The ADP numbers show you that employment growth is kind of flattened out, and you're sort of stuck at around 10% below the highs at the beginning of the year. Very hard to see 6% growth in the fourth quarter in that kind of environment.
What kind of shifts, Steve, are you, seeing? I mean, you talk about these distortions to make sense of what we've seen in the last couple of days, but what are we going to see come Christmas if there's a second lockdown?
Well, I don't think we're going to see a second lockdown. And the distortion, it's the unwinding of a distortion that I'm looking for, namely that this has been a loss of employment that's been heavily borne by people who work in these industries have been locked down. Leisure and hospitality, the unemployment rate is still 25%. In finance, the unemployment rate is 4%. So for most people, the lockdown and the pandemic has been a lifestyle change as opposed to a change in their lives. And as a result, you really, if this 4 million number starts to creep up, you're going to see a broadening of unemployment across more industry sectors. It'll look more like a typical recession. And as a result, the Christmas season, lockdown or not, will not be particularly good.
Stephen, I mean, should we measure things a bit differently because of the severity of the pandemic? Do we also need to think about, the people that are just not making it? I don't know if you look at food banks, but, not people that don't have jobs. It's people that are really struggling and will struggle a lot more in the next year and two.
Yeah, I mean, look, the human part of me does absolutely. And, the loss of the $600 a week for these people is a critical amount of money. And it's one of the reasons why Trump stepped in, and whether it's successful or not, to stop the evictions. But we lost $600 a week, and retail sales continue to roll along. And it's exposing an unfortunate aspect of the U.S. economy, namely that the top 10, 20% of wage earners, where this pandemic has not really impacted because of where they work and the jobs that they have. And the flip of that is that they'll source about 80% of discretionary consumer spending. Their consumer spending, whether it's because of money they take or just a sense of confidence, ties much more closely to the S&P 500.
Yeah, but Stephen, I don't mean to interrupt, but because of time, I just think this is so important. How do guys like you and fancy people like us that are looking at a fancy market, fancy finance, fancy investment, how do you fold in the tangible hardship we see out there?
Well, it's unfortunately it's happening to someone else, and when you have an extended expansion that we had, where basically the higher end got so much more of that income growth. What you do when you get threatened in terms of your income and things go bad is, and actually caused because of the pandemic, is you buy less leisure. So the spending that's gone down has been, in a sense, luxury spending in a way. You're not going to a restaurant as often. But when you look at the growth in employment that helped drive down minority unemployment as low as it did during this cycle, it's all been in these professions that basically serve or services for higher income people. And it's just a very unfortunate dynamic. And losing that leisure spending is, it's very difficult, obviously, in certain industries, but more broadly for the U.S. economy. You see how fast manufacturing has snapped back. You see how fast other parts of the economy have snapped back. So it's unfortunate, and I'm not a politician, so I don't want to get on a soapbox here. But it is the reality of the data that we look at.
Steve Litz, thank you so much with TS Lombard this morning. Futures up 12, Dow futures up 145 as well. Coming up on this interesting day of economics and, of course, the market activity, the laureate from NYU, Paul Romer, will join us in the 10 o'clock hour. Stay with us from London, from New York. This is Bloomberg.
We are above forecasts. 1,800,000 jobs is the total non-farm payrolls, with 17,000 additional jobs added in terms of net revisions.
We still got 1.8 million, with a big decline, almost a full percentage point drop in the unemployment rate, which will move to single digits easily in the summer and fall.
Leading up to this data, there was a lot of reason to suggest that the pace of increase had slowed. And in fact, what we see in this data is, of course, it has slowed, but the good news is that it is continuing, and it is continuing despite some slowdowns that we're seeing around the country as a result of an increase in cases.
People tend to focus on the growth rate. The big issue is the depressed level of spending and income in the economy, which is reflected in the level of the unemployment rate of around 10%.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
We've put ourselves on the front foot again by adapting all the company, by resizing, by adjusting production rates, by adapting the supply chain as well to this new difficult environment.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
This is Bloomberg Surveillance. I'm Karina Mitchell. Let's get the Bloomberg Business Flash. The Justice Department reportedly plans to file antitrust charges against Google in the next few weeks. According to the New York Times, Attorney General William Barr overruled career prosecutors who said they need more time to build a strong case. Some are said to be concerned that Barr wants to announce the case this month for political reasons. And Malaysia has dropped criminal charges against Goldman Sachs in the 1MDB scandal. That's a key step in the settlement that allows the bank to move on. Last week, Goldman paid Malaysia $2.5 billion. It's also guaranteed the return of $1.4 billion from 1MDB assets seized around the world. Goldman was accused of misleading investors while raising billions for the investment fund. And that's the Bloomberg Business Flash.
Thank you so much, Karina. Now, Tom, we wanted to talk about Louis Dreyfus and talks to sell a stake to Abu Dhabi's ADQ. Louis Dreyfus, of course, is one of the most famous agricultural trading companies here in Europe. And according to people familiar with the matter, we don't know the percentage of actually how much would be sold off, but they're in talks to sell a stake in the firm that has come under a pressure, actually. They've had to renegotiate some of the loans to the firm Abu Dhabi Sovereign Wealth Fund, ADQ. Now, coming up next, we speak with Liam Fox, candidate for WTO Director General and former UK Trade Secretary. This is Bloomberg.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This
is Bloomberg Surveillance, Tom and Francine from London and New York. Now, Tom, we know the campaign to lead the World Trade Organization is well underway, playing out against the backdrop of a pandemic, a worldwide recession, of course, the U.S.-China trade war, and the U.S. presidential election. Well, there couldn't be more at stake. Joining us now is Liam Fox. He's WTO Director General candidate and former UK Secretary of State for International Trade. Liam Fox, thank you so much for joining us right here on Bloomberg Surveillance.
Pleasure.
So right now, what's your strategy for making it through the first round of cuts? You've been speaking, I imagine, to representatives of a lot of countries. How many have given them your support?
Well, the process is very confidential, so I won't break any confidences on that. But what I've been setting out is the fact that I think the WTO is a great institution. It's got great technical capability. It's got great people. It's got great institutional memory. But what it doesn't have is political weight. And the problems that we have in the global trading system tend to be political, and I think need to be sorted out at a political level. And we need to give that weight, and I think a candidate with an elected politician with a lot of international experience is well placed for the job. And I think also we need to recommit ourselves to the concept of a multilateral rules-based system. And the lack of commitment, I think, to that politically is one of the problems that we've had in recent years.
Okay, if you look at what the re-election of President Trump would actually do for the WTO, if he does get re-elected, is that a good thing or a bad thing for WTO?
Well, I think if you look at the editorial that Ambassador Lighthizer wrote for the Wall Street Journal a couple of weeks ago, setting out the fact that if the multilateral system can be reformed, if we can get the appropriate changes, America remains committed to the system. I think that most people in the WTO took that as an olive branch. I think that's how it was intended, certainly how it was received. And I think that even those who don't like the WTO and have contemplated life without it have found that the alternative is even less palatable to them.
Liam Fox, to The Rising Tide, your wonderful book from a few years ago. What is the rising tide of world trade right now? The fact is the statistics are down pre-pandemic, and then with the pandemic, there's been a real plunge as seen with the trade balance in the U.S. yesterday. What is the rising tide that can get us back to a multilateral world?
I think that we need to re-emphasize the case for free trade, the case for comparative advantage in economics, the fact that if we have a genuinely open global economy, it's how we help spread prosperity and therefore security. It's how we help allow people to trade their way out of poverty. And what has actually surprised me, Tom, if I may say, is that during this process, the number of people who've said to me, oh, it's great to have someone making a case for free trade, which has caused me to pause for thought, in that if the Director General of WTO is not making the case for free trade and comparative advantage, who is? So I think there is a strong need for us to make that again, because you're quite right, in the fourth quarter of 2019, global trade contracted in both volume and value, and that has become worse by a number of protectionist mechanisms. But if I may say just one thing here, that's the tip of the iceberg. If you look over the past 10 years, back at the end of the financial crisis, in 2009, only 0.7% of G20 imports were covered by restrictive measures. That ballooned to 10.3% by the end of 2019. And there's your correlation between why trade was slowing down.
I want to speak to the general practitioner from Glasgow right now. Dr. Fox, real simply here, in the United Kingdom, in the United States, how do we solve the reticence to go back to the office? Do we need to wait out a vaccine, or can we do it sooner?
Well, I think that inevitably the COVID emergency was going to lead to, I think, an acceleration in the change of behavior, where more people were already working from home. And I think a lot of businesses have actually found that they can cut their costs by not having a lot of staff in and only having the staff in that they actually need. I think that in all pandemics, you get a change in social circumstances and social behavior, which tends to be an acceleration of an existing trend. And that may be what we're seeing now, and we may not go back to where we were before.
Where do you see trade in the next 5 to 10 years? How much is it going to change, given protectionist stance, given a lot of countries wanting to look more inward to give their citizens a better chance?
Well, I think that looking inwards is exactly the wrong way to deal with the problem. I understand that in the COVID emergency, people look for resilience. I think you get resilience and security by increased diversity of supply. It's a basic free market view. The more options we have to choose our supply, the less likely we are to be disrupted by problems in any one part of the global supply chain. So I understand why people would want to, in the short term, look at some of these measures, but we have to ensure that the short-term measures on export restriction, for example, are exactly that. My fear is that, after 28 years in politics, I've come to learn that very often there's nothing more permanent than a temporary restriction introduced in a crisis.
Dr. Fox, thank you so much for joining Bloomberg Surveillance this morning. He is WTO Director General Candidate and the former United Kingdom Secretary of State for International Trade. With our first word news in New York City, here's Karina Mitchell.
Tom, there is an informal agreement to avoid a U.S. government shutdown at the end of the month. Bloomberg has learned that Treasury Secretary Steven Mnuchin and House Speaker Nancy Pelosi will work to keep the government from closing right before the election. That reduces a chance of market turmoil at the end of this month. And Joe Biden drew an explicit contrast with President Trump on his trip to Kenosha, Wisconsin. The Democratic presidential candidate spoke with Jacob Black, the black man shot in the back by police, and he promised sweeping changes to fight racism if he's elected. The president has focused on the rioting and looting that have at times overshadowed peaceful protests. And pressure is mounting on Germany's Chancellor Angela Merkel to drop support for that controversial gas pipeline from Russia. Merkel's waiting to see what Moscow's response is to the poisoning of opposition leader Alexei Navalny. Merkel is no longer repeating her previous stance that the Nord Stream pipeline and the Navalny case should be treated separately. And in France, the government could extend the furlough program it created to protect jobs during the pandemic. That's according to Finance Minister Bruno Le Maire. He indicated authorities are willing to spend more than $119 billion included in the latest stimulus plan. Le Maire also said the French economy could perform better this year than forecast. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Karina, thanks so much. Up next, we speak with Nicola Mai, PIMCO Portfolio Manager and Sovereign Credit Analyst. So we talk a bit about the sell-off we saw in equities yesterday, the linkage going forward, and of course we look at European fixed income. This is Bloomberg.
see coming. Some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
The Boston Symphony Orchestra presents BSO at Home, a collection of concerts, at-home lessons, and behind-the-scenes stories to enjoy while you stay at home. Learn more at bso.org/at-home.
valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise.
The valuation discrepancy between growth and value stocks has been on the table for a while. Those value names haven't seemed to be able to hold a significant lead and come into favor where they stay in favor.
As stock prices in tech continue to go up, their volatility goes up too, which is not a normal relationship. It's usually inverse. And the fact that we, upended kind of 20, 30 years of that relationship and are starting to get that, that made me nervous.
The craziness in this 2020 summer of love for investors was getting out of hand. And then, of course, there's the Robin Hood shenanigans that have been going on. So it wasn't really a surprise.
If you have too much technology in your portfolio, this is the time to start taking a little bit of it off.
A lot of money has been made more recently in tech, so it's not surprising tech has got a little bit more of an outsized downside move in here.
We are looking at a rotation out of the outperformers, sort of a blast from the past, if you will, but we are actually looking at PC stocks.
It is at the beginnings of a healthy correction. We haven't really seen a dramatic pullback.
Uncertainty, as I say, is the enemy of markets.
Well, Bill Ackman there with other market commentators on the biggest rout since June. Now, we're also getting some headlines from Michael Saunders of the Bank of England. Of course, he's a member of the Monetary Policy Committee of the Bank of England, delivering a speech right now saying that there's likely additional easing from the Bank of England that would be appropriate. He also says that the risks to growth forecasts are on the downside. So to talk about gilts, to talk about fixed income overall in Europe, we're delighted to be joined by Nicolas May. He's PIMCO Portfolio Manager, Sovereign Credit Analyst. Nicolas, thank you so much for joining us today. I'm looking at these headlines from the Bank of England. Does the Bank of England, given the deadline with Brexit, given all the rhetoric about negative rates, does it actually have the hardest job out there amongst any major central bank?
Yeah, well, thank you, Francine. I would say that if you look at the GDP print for the second quarter, the UK's print was actually among the worst in Europe. And that was partly to a protracted lockdown and partly to a slow improvement in mobility, at least initially. So I think it is a difficult phase for the UK economy. There is a Brexit deadline. We expect a skinny deal to be signed sometime later this month or in October, but still it is a challenging outlook. When it comes to easing, we do expect a little further a step up in the QE program, but a fairly modest one, about 50 to 100 billion perhaps in November, December this year, on top of the 300 already delivered. We don't actually expect much more than that. I mean, if you've seen mixed comments from the Bank of England, you've had other members of the committee earlier saying that they're more skeptical about QE, partly because of monetary financing considerations, partly because they see it as more efficient and effective during periods of market disruptions. So, and also on negative rates, we are pretty skeptical that they will move into that territory, partly because of the mixed evidence in Europe. So we do see a bit more stimulus on QE, but not that much beyond that.
Nicolas, when you look at the European space, where do you want to be invested in?
So when it comes to Europe, actually, I think the Eurozone periphery, when it comes to sovereign bonds, is relatively attractive right now. If you look at levels, BTPs, 150 basis points over bonds, it's not a particularly high spread, but I think we've seen one thing during the crisis. We've seen a policy response that, after being stumbling initially, actually was fairly convincing. So the ECB, with its double PEP program announcement, actually anchored sovereign markets, and we've had a recovery fund, which is important partly because of its symbolism. So it is a first in terms of having cross-border transfers funded with common issuance. So I would say that, with a very, very deep crisis, Europe has ultimately stepped up to the plate, and so we see some value there. Apart from that, we're pretty selective when it comes to European risk. I mean, one area we tend to like are the banks, partly given the solid balance sheet. Let's remember that the banks, while the corporates were levering up, have been deleveraging. And so we think actually different areas of the European bank bond market, especially the lower part of the capital structure in different national champion banks in Europe, offer some carry.
Nicola, good morning. Tom Keene from New York. PIMCO's had a great call, really successful call on a dampening of interest rates, a dampening of economic growth. I want to go back to your JP Morgan tenure and the great call by Jan Loeys for just grinding lower interest rates. Is that vector still in place? of a sustained nominal yield that just grinds ever lower?
I would say so, Tom. I think that the so-called new neutral that we discussed a while ago, predicated on an excess of savings over investments due to factors like demographics, high debt levels, and generally speaking, caution after the financial crisis, are probably going to be deepened by this corona crisis. So if we look at private saving rates globally, they've been going up high, they've been going higher and higher, and obviously debt levels have been pushed higher and higher by the crisis. So I think central banks are going to be committed to keeping rates low. Partly they're being forced to keep rates low, partly because of the very high debt levels. So if anything, I would say interest rates are here to stay very low in nominal terms, and in real terms, they could actually fall further even from these very low levels.
What will be the ramifications of that? What is the European ramification of dampened, hugely negative real yields?
Well, one of the ramifications is the effect on banks. Bank profitability is being squeezed. Now, that is not really affecting the outlook for bonds, which, as I said, they still have some cushion from the equity side. But when it comes to bank equity prices, for example, they will probably remain under pressure. I think also if you keep rates low for a very long time and you have fiscal stimulus continuing beyond the near term, once the economy has normalized, eventually, you could have a rise in inflation, which could actually help with the debt levels. Now, we see that as more likely in the US than in Europe, but I think over time, I think the inflation risks will probably build.
Nicola May, thank you so much. Greatly appreciate it. He is with PIMCO. Good fixed income brief there. Again, futures up 14, Dow futures up 155. The 10-year yield, boy, what a change from that 0.70 level. Lower yields, higher note prices, 0.65 to go to 2 digits. It's too early to go to 4 digits this morning. Coming up at the 10 o'clock hour, John Bolton, the former U.S. National Security Advisor. Much to talk about, including Jeff Goldberg's article in The Atlantic, the talk of the nation last night. Stay with us. This is Bloomberg.
Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
what you need to be watching on Friday. The main event, U.S. payrolls report closing out the week. It is a big week.
This is Bloomberg Surveillance. I'm Karina Mitchell. Let's get the Bloomberg Business Flash. Broadcom is predicting a smartphone chip rebound in a bullish forecast. The company's revenue outlook for the next quarter was higher than expected. Broadcom's products include components for smartphones, servers, cars, and software that runs the biggest mainframe computers. The Chinese banks are planning near record bond sales this month. Banks such as ICBC, the world's largest lender, want to replenish capital levels weakened by a surge in cheap loans to struggling businesses. They plan to raise almost $29 billion. That would be the second highest monthly bond sale ever in China. And Virgin Atlantic Airways plans to cut hundreds of more jobs. Bloomberg's learned the cuts could result in a 40% reduction in the workforce since the start of the pandemic. They're likely to be announced today. The move would come a day after Virgin Atlantic got final approval for a $1.6 billion rescue package. And that's the Bloomberg Business Flash. Fran, Tom.
Karina, thank you so much. It's been an extraordinary 24 hours with I'm not going to say rout, but a pullback, a measured pullback, and of course tech doing a little bit worse. We were very fortunate yesterday that Vonnie Quinn had an extended conversation with William Ackman of Pershing Square Capital Management. Let's listen.
Not the beginning of the end, but I would say we're coming upon one of the more uncertain periods in American history, right? We have a very divisive presidential election coupled with, a virus that's had a huge impact on the economy. And the markets have been remarkably strong since really the third week in March. And so it's not surprising. Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty, and we have an election in 60 days where it's a toss-up who's going to be the next president and what the policies of the next president, whether it's Trump's second term or Biden's first term, what that means for the country, what it means for corporate America, what it means for taxation. These are uncertain issues, and uncertainty, as I say, is the enemy of markets.
You had said that it wouldn't change your investment position no matter which person was to be president for the next administration. Are you changing your thoughts on that now? Do you think there would be widely different policies were there to be a Biden administration, for example, rather than a second Trump term?
I don't know that it's completely knowable. I think Biden and his choice of a vice president suggests a more kind of moderate as opposed to more progressive Democratic administration, to the extent that Biden is sort of the winner. But I do think they're going to have different policies and different approaches toward, taxation, business, et cetera. Although I do think Biden, Kamala Harris is in a more moderate camp than a Biden, Warren administration, for example.
I do want to push you a little bit on valuations, because you mentioned how things had maybe got a little fully valued or overvalued, but a DocuSign down 12%, Tesla down 8% today. Is that closer to sort of the real valuation for these companies, or a fair valuation in this environment? Or, could there be even a lot more to go?
So I don't know enough about either of those two businesses to know whether the price is a fair price or not. But a lot of, I would say, when I speak about valuation of some of the more high-flying companies, a lot is predicated on what's going to happen in the future, right? What's interesting is when you have a world with almost 0% interest rates, the discount rates you use to discount the future are very, very low. And so with companies which are growing very rapidly, low discount rates, rapidly growing companies, you can get to very high valuations. Although the problem is small changes in your assumptions can lead to a very different outcome in terms of what a business is worth. And I think those small changes in assumptions can relate to someone's confidence in what the future looks like. And I think it's hard to predict the future when we have an uncertain sort of political environment and just the inherent uncertainty about the virus. Yesterday, CDC tells states to prepare for, possibly a distribution of a vaccine November 1st. If there's a real vaccine that's distributed in scale before the end of the year, that has a meaningful impact. If there isn't one until the second half of next year, that has a meaningful impact as well. I just think it's not known today, what those outcomes are. And you factor in your risk premium, should go up when there's more uncertainty. And the risk premium relates to the discount rate. It's the risk-free rate plus a risk premium that you use to discount the future. And many rapidly growing companies, you can't justify the value placing a multiple on next year's earnings, which is sort of the convention for many kind of more mundane businesses. You have to make certain expectations about a company's ability to become profitable and for those profits to grow at a pretty rapid rate to justify many of the values or the collective values of where many of these companies were trading. And I think that is inevitably leads to more volatility when there's uncertainty.
The ups and downs of Mr. Ackman recently, very up, of course, with Pershing Square Capital and there with Arvani Quinn. This is a wonderful story. There's the employment report out and the market gyrations, and there's also, hearkening back to 1851, one of the great merchant houses of Western history. Louis Dreyfus, of course, has been taken out involving billions of dollars by Margarita Louis Dreyfus. I'm saying Dreyfus, Francine says Dreyfus. I'm sorry. She's looking for an investor and has reached out to Abu Dhabi for truly one of the great 4 agricultural trading houses of the world. They're known as the ABCDs, and Louis Dreyfus is certainly one of those as they go looking for new capital. So that'll be a story to watch, particularly for the continent here in the coming days. We have a story to watch, and that is jobs at 8:30. We are thrilled to bring you in moments Catherine Mann of Citigroup. That'll be most extraordinary on this odd jobs report. Futures now, a round number up 20. Stay with us. This is Bloomberg.
Even though fans can't attend this year's U.S. Open, they're closer than ever to the action. At home. IBM Watson is serving up game insights from millions of data points. And IBM Cloud is helping deliver flexibility and security to reimagine the tournament on and off the court. Now, tennis fans have the advantage.
Why pay over $100 a month for cable when it's half the cost for Fubo TV? Get all the channels you want with all the entertainment you love for the price that cable can't beat. Try free at FuboTV.com.
Our primary customer are the Vietnamese American sending money back home. After the pandemic started, people cannot go out and send money. Our business went from 100% to 0 overnight. So with the help of Wells Fargo, we
This is Bloomberg Best, your weekly review of the most important business news analysis and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
How has it shaped the leader you've become in dealing with this pandemic?
What I find to be incredibly valuable in a situation like this is having that breadth of experience leading large organizations.
This morning, do the math. Was it a rout? Was it a plunge? Was it a pause that refreshes? The Standard & Poor's 500, it has cratered, I say, 4.5%, back to where it was 8 days ago, and just near the pre-pandemic Valentine's Day peak. Should you go to cash? Well, if you're in cash, now what? Do the math. Well, you can't. Disagreeing economists, they agree there is mystery in this morning's jobs report. We'll go beneath the headline data at 8:30. Catherine Mann in moments. And line up the losers, from the Marines across a wheat field in France to a Navy pilot at Midway to a guest of the Hanoi Hilton. President Trump must confront the military, hide the amputees. Good morning, everyone. This is Bloomberg Surveillance from New York, from London as well. In Washington, Francine, there is no other discussion but Jeffrey Goldberg's essay last night released by The Atlantic. It created an immediate firestorm. President Trump aggressively denied the story with, I believe, 4 sources cited early in the article. It's amazing, Francine, in a given election, how one story can shift the dialogue.
Yeah, it shifts the dialogue maybe, Tom, but I don't know what impact it has on the polls. And again, if you look at polls, one of the interesting conversations, that we have as we are in an election year, that I think a lot of banks are now realizing it could be one of the most volatile moments for the markets, is exactly whether you look at state, the swing states, or whether there's a broader change of heart or change of mind when it comes to that November election.
Yeah, Russ Beckwith was brilliant on that yesterday. Really, he's talking about the swing state polls as the thing to watch here into September. Right now in New York City with our First Word News, here's Karina Mitchell.
Okay, Tom, Republicans and Democrats have agreed on one thing. Treasury Secretary Steven Mnuchin and House Speaker Nancy Pelosi are working to avoid a government shutdown right before the election. They won't let the stalemate over virus relief legislation hold up a vital stopgap spending bill that clears the way for the government to stay in operation at the start of the new fiscal year. Meanwhile, President Trump has denied a magazine account that he disparaged America's war dead as losers. According to The Atlantic, the president tried to get out of a visit to the graves of American Marines killed in World War I in France. He reportedly said, quote, "Why should I go to that cemetery? It's filled with losers." The president calls the account a total lie. And the suspect in the shooting of a right-wing activist in Portland, Oregon last week has been killed. Federal authorities say they were trying to take Michael Reinhold into custody when officers shot him. Reinhold was a vocal supporter of the far-left Antifa movement. And the U.S. labor market probably saw a 4th month of improvement in August, but chances of further outside gains are diminishing without the stimulus payments. The monthly jobs report is out at 8:30 New York time this morning. Economists project the unemployment rate dropped below 10% for the first time since March. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Fran, Tom.
Karina, thanks so much. Equities, bonds, currencies, commodities, uncorrelated. That's what we saw yesterday with that drop in equity valuations, but other parts of the greater market really not participating. Futures rebound, up 22, Dow futures up 237. Now I'm going to call that highs for the session. The VIX comes in 2 big sticks, but to be honest here, we went from 21 to 24, and then we blew out to 33 yesterday, 31.52 right now on the VIX. And the rest of the market shows a real quiescence there, perhaps waiting for the jobs report. Francine?
Yeah, Tom, I think it's all about the jobs report, and it's also ahead of a holiday in the U.S., of course, on Monday, so we could see a bit more volume, certainly, when it comes to European trade. Now, trade is subdued, more subdued maybe than last week. Investors holding off making any changes before the jobs data and maybe before the U.S. holiday weekend. And then if you look at European bank stocks, they actually rallied after news that Spain's CaixaBank and Bankia are exploring this 14 billion euro merger, Tom.
We'll look at the markets here in a bit, but right now on the jobs report coming up in 2.5 hours. Joining us now, Catherine Mann of Citigroup, their global chief economist, and she has the rare charm of being at the absolute heights of academic economics, including her codependency analysis of China in the United States, and then proving at the OECD she could do market economics like nobody else. It's a rare beast. Catherine Mann joins us this morning. Catherine, let's go all jobs report here. What is the Citigroup nuance of what we're going to observe at 8:30?
Well, I think the question is, how many people come back to work, and then how many people are coming back on the pandemic unemployment assistance program. I mean, the decomposition between those two programs, I think, is a very interesting one to pursue, because if you go off of one and then go on to the other, you're not improving your job situation. So I do think that that's an important piece of information.
We saw that from Heidi Shearholz yesterday at Economic Policy Institute, folks. When you take the better news of the unemployment claims and then your jobless claims and then you add on the pandemic reports, you really don't get much of a decline. Catherine Mann, in the jobs report, we've always had the U3, the U6, Chairman Greenspan's augmented unemployment rate, and then, the all-in unemployment rate. What's the unemployment rate right now of the United States of America?
Well, there are an awful lot of people who are on furlough. And I think one of the important questions going forward is how many of those furloughs turn into firings, because that's going to make the unemployment rate go even higher. And it's a more permanent situation, which is going to affect people's expectations and their consumption patterns. So, we've heard some announcements from some large hospitality and, of course, the airlines about going from furlough to firing. We've got small business arguing that, if there's not more assistance, they're going to go under. So, this jobs report is important, but I think, in terms of evaluations and so forth, we've got to look beyond just the what happened this week to the longer term. And, the longer term is not looking good right now in terms of the support for consumption and therefore for business investment and growth in the U.S. economy.
Catherine, good morning from London. Are these jobs that are permanently lost, or are they jobs that, eventually will get back? Is it basically, companies going bust, or is it just companies downsizing?
Well, on the small business side of things, there's a lot of turnover in small business, but nevertheless, that time period between going bust, and small business does go bust. They close up shop, the owners go away, and those jobs are, in some sense, lost to the churn, and the churn can be a very long time at the very, very low income levels as well. That's one of the problems here, is that the people who are at the lower income levels, the ones who are always on the edge, are the ones who are bearing a particular burden this time around. For the furloughs to firings, those, again, hospitality, airlines, those are still at quite a bit at risk. I mean, airlines are only at about 50% travel rates. And, if you ask people, are you worried about going to a large group gathering, 85 to 90% still say yes. So that's not good for going to entertainment or going to, the concert venues. That's bad for hospitality.
When you look, Catherine, at what happens in the next 3 to 4 months, so let's say that the rate of infection goes higher, are we going to lose more jobs rapidly? Or is the winter months the crucial months?
Well, I mean, what's interesting right now is that the winter months are coinciding with what many of the vaccine developers are saying are potentially very good months for perhaps coming through with a vaccine. So they're balanced between the winter months with the regular flu and the vaccine. That's an interesting balance to consider. But I do come back always to how do consumers respond? Just because there's a vaccine, does that really make them think that, yes, I'm going to go back and do the things I used to do before? Certain age groups seems to be, perfectly happy to go out there and mingle and have fun. And would go to the concert venues, would go to sporting events. But the older generation seems much more concerned. And when it comes right down to it, the old people have a lot more money than the young people do. And so that has implications for spending patterns.
Catherine Mann, linking in this job economy to aggregate demand in the greater sense of GDP, on the back end of the equation is a Catherine Mann variable, net exports. It's not very pretty right now. How large a dampening impact is this collapse of world trade going to be?
Well, actually, if coming from last month, I would say, trade was completely on the back foot. But our early warning indicator on the container throughput index does indicate that there is some coming off of the bottom. Now, I think we have to be very careful, because coming off of the bottom still means trade contraction of about 5%. Well, trade contraction of 5% is better than trade contraction of 15%, but it still does represent a contraction. And, this is a very important ingredient, not just for the United States, but also for a lot of other countries around the world. And so, collectively, this trade contraction is something that we are viewing as a very severe headwind to the global economy. It may improve a little bit, but again, this notion of rebound is a very different word than recovery. A rebound just means that you get back to where you used to be, and that wasn't a great place. We haven't made up any losses at this point. We're still in a hole.
Catherine Mann, thank you so much. And the good news here, folks, is we'll continue with Dr. Mann. I really want to address her classic analysis of the codependencies of our international economics. Lawrence Kudlow, our National Economic Council Director, he will look at the codependencies of the political season as it links into today's jobs report. Assisting him will be Dr. Farrow. Look for that in the 10 o'clock hour. This is Bloomberg. Good morning.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is a step in the right direction. Perhaps it's a harbinger for more changes in the future, like the completion of the banking union.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Well, still with us, Catherine Mann, Citi Global Chief Economist. Catherine, we're talking a bit about the U.S. and the jobs report that we're expecting later. When you look at the world economy right now, where do you see the most scarring, and how deep will that scarring actually be?
So I think when we're looking at this, one of the most important disconnects among the many that we see around is the pace at which our own country economists say that countries will get back to their pre-COVID level of GDP is maybe next year or maybe 2022, but no one is talking about getting back to the pre-COVID level of unemployment or the pre-COVID level of employment. And I think that disconnect between people thinking their economy from a measure of GDP is going to be coming back, no one says that for unemployment. And that says that there is an extended period of time when we're going to have, expectedly, very high unemployment rates. And we know that the scarring from the global financial crisis, which kind of looks a whole lot like this in terms of GDP kind of dynamics, that scarring was particularly damaging to younger generations because they're the ones who are not getting the first job or are not getting the raise or are not getting an opportunity to develop into their careers. So in some sense, the younger generations are the ones who are most scarred. It happened in the global financial crisis. I'm concerned it's going to happen here as well.
But could it be ugly? I mean, how does this differ actually from what happened in the financial crisis? We're in a much better place.
Well, I'm not sure we are in a much better place. I mean, from a standpoint of banking, the stability of the banking sector, yes, we are in a much better place. But in terms of where we are in unemployment, where we are in business investment, where we are in consumption, we're not in a better place. We have higher inequality, we've got lower productivity growth, and so we're not actually in a better place. And of course, one of the things that the Federal Reserve is trying to do through its policies is try to avoid having a whole range of financial meltdown, perhaps in 2021, to add on to what still is a very fragile recovery in the global economy. So, I would say we're not in a better place right now.
Catherine Mann, is the codependency shattered? I just moved, and 98.2% of the junk I bought was made in China. I think the rest of it was made in Vietnam. With all this trade uproar of this administration, have we shattered our codependency?
The trade relationship has changed dramatically, although the codependency, which back then, 10 years ago, I suppose your furniture is 10 years old, I don't know, that was with regard to goods. Now we've got a codependency that is still there, and we're trying to rip it apart with regard to technology and information. Technology and AI and those sorts of things, that there still is a very strong codependency between the U.S. and China on that score, simply because of a lot of production being there, but also some of the higher level technologies. So of course the issues with regard to the large technology companies is the breaking apart, the efforts to break apart that relationship. On the financial side, in terms of financial flows, there's a deepening codependency with regard to financial flows as China has been added into the MSCI, for example, and upweighting the shares as they are expanding the ability of U.S. companies, financial institutions to enter into their financial market. So there is, if anything, there's a deepening on the private financial flows. Even as we know that there's some pieces of legislation with regard to having China in certain kinds of portfolios, and of course some concerns with currency countervailing duties, and some concerns with China on the China side with purchased Treasury securities.
What is just because of time, Dr. Mann, I've got to get this in. It's so important. What's our best practice of technology codependency? What would you recommend is a best U.S. practice with China?
So I think that the issue there has to be about full transparency about what's going on kind of inside the box. That is necessary not only to assuage concerns about national security, but it's also necessary for companies to be able to work together. So that has been a challenge. Because, of course, inside the box is very proprietary, but there are standards setting bodies where it sounds like it's the nerdy people, the technology people, who do have the wherewithal to talk to each other about what's inside the box, and that's, or inside the algorithms. And I think that's the way we have to go. I think that's the way we should go in order to have a deep relationship on the technology side, and of course bringing in other economies, Europe, Australia, et cetera, and Japan. But I don't hold out hope that will happen. That would be best, but I don't hold out that hope that will happen.
Catherine, when you look at your projections, in terms of GDP inflation forecasts, I mean, how do you model a possible second lockdown, or is a second full lockdown like we lived in, March, April throughout a lot of the Western world, something that we're discounting at the moment?
I think we're not going to have a second lockdown. I think that in countries, in Europe, in Korea, in Japan, and so forth, these are countries that have been able to target efforts to problem areas. In the United States, there's simply not going to be a whole-scale lockdown. Again, the states will take a much stronger role of choosing the strategies that seem to be the appropriate ones for them, and will have a much lighter hand, simply because the economic damage would be too great. And also, there's the tremendous hope that the vaccine is around the corner.
Dr. Mann, thank you so much for the brief on the American labor economy and, of course, her path-breaking work on China. She is chief economist with Citigroup. Coming up as well, someone that can keep up with Dr. Mann, his name would be Romer, a couple blocks away from Citigroup, well, not more than a couple blocks away, down to New York University, the laureate, Paul Romer, always interesting, fascinating on the changes of our technological world in the 10 o'clock hour. It is Jobs Day. Stay with us till 8:30 in that important report. This is Bloomberg.
De esta manera me gustaría decirle a los empleadores que fueran más humanitarios con sus trabajadores, que les hagan valer sus derechos.
Y estábamos viviendo en dos casas, en unas 50 personas y en la otra otras 50. En cada casa había 5 habitaciones. En cada habitación había de 3 a 4 camas abarrotadas. Vivíamos de 6 a 7 personas. Un baño para cada habitación y una cocina para todas.
Una vez que nos atendieron en el hospital, al salir nos avisó una compañera que ya nos habían reportado a migración.
Gracias a Dios ahorita de salud yo estoy muy bien, pero en lo moral no estoy muy bien, porque a causa de esa enfermedad yo perdí todo, perdí mi trabajo.
Yo creo que mi caso resulta un gran problema de cómo las personas migrantes estamos en riesgo de explotación por parte de los empleadores.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I do double down on helping other Black founders, whether it's fundraising, hiring, growth, product, whatever it is that they need.
This is Bloomberg Surveillance. I'm Karina Mitchell with the Bloomberg Business Flash. The Justice Department reportedly plans to file antitrust charges against Google in the next few weeks. According to the New York Times, Attorney General William Barr overruled career prosecutors who said they need more time to build a strong case. Some are said to be concerned Barr wants to announce the case this month for political reasons. Meanwhile, Malaysia has dropped criminal charges against Goldman Sachs in the 1MDB scandal. That's a key step in the settlement that allows the bank to move on. Last week, Goldman paid Malaysia $2.5 billion. It's also guaranteed the return of $1.4 billion from 1MDB assets seized around the world. Goldman was accused of misleading investors while raising billions for the investment fund. And Yum China has joined the ranks of U.S.-listed Chinese companies selling shares in Hong Kong. The operator of KFC and Pizza Hut restaurants raised $2.2 billion in its second listing. Hong Kong is riding a wave of investor enthusiasm for IPOs. It's set to get a big boost from the mega IPO of Jack Ma's Ant Group. And that's the Bloomberg Business Flash. Tom, Fran.
Karina, thanks so much. Equities, bonds, currencies, commodities, nice bounce and correlated to the market. Risk on feel off of the carnage of yesterday. Futures up 11, Dow futures up 151. Dow level 28,500, down